Director, I believe we have a full quorum for the record, and so please, if you like, begin.
Thank you, Mr. Chairman. This meeting has been noticed for the State Loan and Investment Board as a special working session for the State Treasurer's Office. These matters are generally D matters on the agenda for state investment matters. And with that, I would yield to Mr. Sackett and Mr. Treasurer to take it from here.
Mr. Treasurer.
Thank you, Mr. Chairman. We've got, I think, a fairly strong agenda to get us moving here, and we're going to turn it over first to Matt. I think we're supposed to have our investment team here, aren't we?
They're here.
Start?
They are in the back.
there? Oh, there they are, right behind the podium. Okay, all right. Okay, so we're gonna start with the market value valuation update, and then we'll move into asset allocations and get rolling on that. So Matt, go for it.
Mr. Sackett. And I would note for the record too, that I believe every one of us has also had a separate briefing too, so.
Mr. Chairman, members of the committee, yeah, I'll just invite up Patrick and the investment team to start off with market valuation discussion, kind of opportunities in their different areas of expertise, and let them go from there.
I'm not sure we have Patrick.
Patrick's here.
I do note while we're waiting for that, Tom Chapman and Dick Granis are on the Zoom.
Good morning, Tom. Good morning, Dick.
Good morning. Good morning, everybody.
Oh, all right.
And Ken Lay. That does not look like Glenrock, Ken. You're on mute, sir.
Yeah, that's the Mount Washington Hotel at Bretton Woods.
That I figured.
I'm going to be keeping myself on mute because there's construction going on here and I've got a lot of background. There's a bunch of background noise. So.
Very good.
Ken, I'm going to at least send you a Wyoming background, at least, if when you come on.
Let's see. I might be able to switch. Let's see here.
Oh,
yeah, there
Mr.
we go.
Fleming has arrived.
There we are. Is that better?
We have some more chairs. Okay. Hey, Matt, there's another chair over there.
Good morning.
Good morning. Sorry for the delay, Mr. Chairman.
Nope, we're off and running. We were just saying pleasantries with Tom and Ken and Dick, who are all online. So,
Mr. Chairman, members of the committee, IFC, name is Patrick Fleming. I'm the CIO for Treasurer's Office. First of all, thank you all for coming today to this, I feel, the most important meeting of the year that we have. This is the time when we are putting together the asset allocation, which all of you know, depending on who is speaking, or the academic, between 90 and 99% of our returns. And so, I can't say more than how important this meeting is. First of all, before we start off with our staff and talking about some of the opportunity sets and what they're looking at, and then Josh is going to go into the big deck. One, I just want to phrase a little bit of what's going on in the market and the opportunities that we see. So big picture wise, Josh is going to talk about the capital market assumptions, the CMAs, which are a 10 to 15 year type of return. And I just want to highlight a little bit about what's going on in the near term to make sure that you kind of see where we're coming from and where the market is. So right now, the prognosticators across the United States, all the academics are saying there's a 68% chance of a recession within the next 12 months. We would agree with that. It's very hard to predict, But all of the different indicators that I've mentioned over the few years, and, we kind of got short-circuited. We thought we were going to enter one into COVID, and then the Fed came in and massively stimulated the economy. But in that environment, as you know, the Fed lowers rates, tries to stimulate the economy again, and we go on from there. We feel that it's going to be a little bit different this time because of the low level of unemployment. That we've seen 2.5 million people leave the workforce. So the participation rate is very low. And historically, it's called Okun's Law, but a 1% or 2% increase in unemployment, 1% in unemployment drops GDP by 2%. And so we think that's going to be a little bit more muted now because we don't have the workforce. We do not have the immigration policies that we've had in the past, and we have a very old workforce that is not coming in. So what's happening on that is the employment situation is stickier than you would anticipate at this time of the year. So what does that really mean? We still believe that in classic recession, you're going to see pressures on margins. It's every recession in the world, you've seen a drop in margins. And so valuation wise, if you look in your green book, in the RVK report at the very back, what we do every week is we look at valuations across the board, and we look at them as short-term valuations and a long-term valuation. And so in this instance, US equities on a 10 percentile range right now are at the 68th percentile of valuation, so richness. Meanwhile, the ACWX, which is our international benchmark, is sub 20, I think it's 18. So in that instance, we are more predisposed to say we like international more than US, and that's where our weight is. We have a significant overweight to US equities. We're fine on that. To me, the most interesting part here that we're going to discuss today is fixed income. So over the last 15 years, fixed income really did not have a lot of value. As you know, zero rates, very low vol. There's just not a lot of opportunity set. To me, this is extremely important. The other side of it is if you look at the volatility in fixed income, we're at the highest volatility since 1986 in relation to equities. All the volatility is in fixed income. Why is that? Well, we have the Fed moving quite rapidly. But the other side that I just want to mention, and kudos to Cheryl and Caleb, is there are so many people out there, and I've had conversations with numerous people. I was speaking at Milken last night or 2 nights ago with Ken Leach, who's been doing this for like 40 odd years. And he said, it's shocking how the traders and the people that we're dealing with and people that I've hired do not understand the basics of fixed income because they have not seen this interest rate increase. And so one thing I think that we have a competitive advantage of is to look at some of these valuations and understand what happens when the Fed raises rates so rapidly, and what happens when 10 years move like they did in 1986, 1993, 1906. In these periods where you saw these big hikes, the vast majority of these traders and people have never seen this type of environment. So it's created, I think, a tremendous opportunity to take advantage of it. And where we really see a tremendous advantage is in the private credit market in this area. Reason being is we can lock in a 10, let's say 8 to 11% return in the private credit market. Senior secured, so we move up capital stack. It's a more secure investment, higher returns, longer duration, about 25% of the portfolio is a long duration where the other part is floating rate, and take advantage of some of these opportunities that we haven't seen before. So why is the opportunity set there now? 1, because of the rates and what's happened. 2, as you know, with this mini banking crisis that we're seeing, banks are not lending. When your deposits are coming down, what do? You have to shrink your deposit base. You have to shrink your loan book. Charles Schwab last year paid 61 basis points. 61 basis points. Right now you can buy, overnight funds, close to 6%. All that money's going back into money markets and getting this. They don't have the deposits. What do? You have to shrink your loan book. So this is creating a vacuum, a hole for this opportunity set. The other side is going into a recession. There are so many people who have invested in this zero rate environment, and now they have to pay the interest cost, and they are not set up for it. So in the private equity side, the next area that we're looking for is in secondaries. These are issues where you're going to see roll-ups, people who have over indebted themselves. The average leverage in private equity is 5.5 times cash flow. So when rates were low, 35% of their payments were on interest. Now, depending on your leverage and where you are, it's anywhere from 75 to 150 times, 1.5 times. What do? Well, when you're running out of cash, that burn rate, when you run through the cash, when that's gone, you have to refinance. We have a debt wall coming up. 2024, end of 23, 24, whether it's high yield, private equity, what have you, these people are going to have to refinance. The covenants are going to go up. Many of them are not going to be able to find financing. Spreads are going to widen. We just feel that this is, over the next couple years, this is a tremendous, tremendous opportunity for the fixed income market. So with that, I will pass it over first off to Cheryl. I hope I didn't steal too much of your thunder on the fixed income side, but I just wanted to kind of preface of where our focus and what we're looking at. And then we'll pass along to the other people just to give a short overview of where our managers feel the opportunity sets are.
Thank you, Patrick. I'm Cheryl O'Connell. I'm the Senior Investment Officer overseeing the fixed income group or fixed income area. And as Patrick mentioned, the last couple of months obviously have been very tumultuous in the markets. We've seen some historic moves in interest rate volatility and daily moves in interest rates themselves. So it's been quite the time to be in that sector. But again, as Patrick was saying, it's also one of the first times in the last 10 to 15 years that we've actually seen any sort of value in the fixed income market. So from that perspective, we think it's a really attractive area to be at this point. In general, we're seeing, the Fed hiked yesterday. We expect that they're probably going to pause for a while here to just kind of see what the impact is, of what their interest rates have done over the last several months. And so we think for a while we'll be sitting in this point. Market currently is pricing in a number of rate cuts going into year end, anticipating, that we'll probably be heading into a recession. I think as long as we continue to see employment at the levels that we're at and we continue to see inflation where it is, I think it's going to be hard pressed for the Fed to start cutting rates going into the second half of the year unless we see something else break, as we did with the banks. And so, but regardless, we're kind of positioning ourselves to make certain that, we're protected from the downside that may happen. In most of the sectors within fixed income, spreads have widened a lot. The risk spreads have widened a lot over the last year, but we're really just sitting at kind of average levels at this point. So anticipate that we're going to see some additional widening, which would result in the cheapening up of the bonds for the rest of the year. But overall, that certainly is going to bring some opportunities within the different sectors, but, expect that generally will be fairly orderly as things happen. Our biggest conviction trade right now is just within the bank loan sector. We've been underweight bank loans for the last 6 or 8 months, but the big issue there, again, as Patrick was talking, these are highly levered companies. They're small companies. They're floating rate loans. And so as they're looking to service this increased interest rate and we have decreasing growth opportunities for these companies, it's really going to become much more problematic for them. And so that's why we've been sitting underweight in that sector for the last year and anticipate to do that, as if we see any firming in spreads over the next, several months, it's going to be an opportunity for us to, we'll look at that to lighten up that position additionally so that we can move the assets over to areas such as private credit or infrastructure where we see that there may be more opportunities moving forward. So, any questions on that?
Are there questions? Secretary.
Thank you, Mr. Chairman. Can you speak to your thoughts on the possibility of a spread of a banking crisis?
I think that we've seen, right now we've seen additional companies. I mean, we saw First Republic go down the other day. Some of the other banks that are out there, from an equity perspective, it's concerning for the equity holders. They were completely wiped out in the last 3 banks. Anybody who's holding the equity is looking to get out of it as soon as possible. But in terms of, the money was made available to them by the Fed for these different banks, it really has been able to control a lot of the contagion that's been out there. The banks that have suffered a lot of the problems and have failed in the last several months really were fairly unique in their deposit structure and their makeup of the loans that they had on their books. And so put them a little bit, in a different position. But in terms of most banks being able to meet their deposit needs, or the needs of their depositors in the event that there's outflows, I don't expect that we're going to see much more contagion from that.
Mr. Chairman, Mr. Secretary, just to add on to that one, that's a classic example of what I referred to of you have the JV running some of these institutions. I mean, this is not rocket science. This is first day, first grade stuff. To look at the difference of what they were doing is just deplorable. It was just ridiculously stupid risk management, what like Silicon Valley Bank was doing. It's just basic understanding of what happens with markets and when interest rates go up. And they had some very junior people, no risk manager. SVB didn't have a risk manager. Some of these things that happen. So typically when you see a banking crisis, it's a credit crisis, right? This is an interest rate situation. It has nothing to do with credit. The credit of these institutions are still very good. And so what the Fed has done after the great financial crisis is they designated these SIFI banks as strategically important financial institutions and increased their credit. So if you look at the major banks, the main SIFI banks, they're extremely well capitalized and rock solid. So we do not look at this as a banking crisis per se, but much more of a mismanagement in an interest rate situation, exactly what I was pointing out. When rates go up as quickly as they have done, the first time since 1980, for these people who have not been aware of what's happening, bad things will happen. And we firmly believe this is only like the 3rd or 4th inning. There are going to be, if the Fed holds rates here for the rest of the year like they said they will, we will see other institutions fail.
Follow up?
Mr. Chairman, what do you think is the culture at these banks? I mean, you talked a little bit about not having a risk manager. There's been a lot of reporting about them so focused on their woke signaling that, they can't focus on actually getting the job done. Have you studied this at all in terms of, what the culture is at these banks and how you evaluate the culture that they're actually doing the job rather than going out and partying and, doing this woke signaling stuff?
Mr. Chairman, Secretary, it's not that these people are partying or anything. They're extremely sophisticated, smart people. But there is an element of greed here. And there's bulls, pigs, and pigs. And when you're a pig, you get slaughtered. And that is exactly what's happening. Is what's happened when you have zero interest rates for so long, you get this Pavlovian response of just saying, hey, money's free. Let's just go out and buy this stuff. Let's go out and do these things. And so that has been permeating through the entire economy for over 10 years. And now all of a sudden, when rates go up, most of these people, now the corporate investment grade areas have done a very good job in terming out a lot of their debt, but a lot of these other institutions have not. And when you didn't term out your debt and you're all of a sudden your 80, 70% is short-term rates, it's a problem. And so I would highlight that it's not that they're not working hard and not intelligent and everything else, but a lot of them have just been very greedy. The other side of it is looking at the liquidity platform, and we're going to get into much more of the in-depth in the liquidity part of it. But if you look at what's happened since the GFC, we have moved out. If you look across the investment spectrum when we're talking about all the different financial institutions. We have moved from 20% of liquid markets to illiquid markets. So 20% of the liquidity has been taken out of the market into these less liquid, the private equity, hedge funds, some of these less liquid investments. And so why? Well, when you're at 0 rate and you have a 7% actuarial return, what are you going to do? So you had to load up into some of these much higher, riskier assets. And that is what we're seeing now, is when you have this decline and you don't have the liquidity, problems surface.
So, Patrick, good point. I think we're going to talk a little bit about cash flow and cash accessibility as we go through this. The one thing, Cheryl, that I was interested in, and I think you've really described the situation, the one overhang on all this is credit card debt, which is really ramped up and continues to ramp up. What do you anticipate that pressure bringing to the banking system?
Well, to be honest, a lot of that credit card debt is securitized and kind of taken off of the books of the bank, so they're not necessarily suffering it. You're seeing those credit cards receivables issued in the asset-backed security market. And so by doing that, it puts the burden of loss on investors and removes it somewhat from the bank. So, that's not all of the receivables, but, it certainly is a large portion of it. And so, it will help alleviate some of the stress that you would see in those sectors.
And just to add, Mr. Chairman, the other thing that we've seen is with all the stimulus, the money that's coming in, we've also seen a significant move in FICO inflation, let's say. If you look at the amount of subprime, the percentage of borrowers in subprime moderately versus, senior, it's shifted dramatically into a much stronger credit. So as you mentioned, you're definitely seeing the stress now in the subprime, but as a percentage of the market, it's much smaller.
So the big concern I have is that we trained everybody that if you're too big to fail, we'll resolve you. Oh, we won't resolve you, we'll just bail you out. And that's the big concern I think you see, to the good secretary's point. We've trained everybody. You not only did you drive them to risky assets and tying up their cash, but you also at the same time basically said, fair game, we'll fix, and which is what you're hearing, I think, a lot out of Congress at this point. Lower rates, let's keep things going, keep people employed, et cetera. So anyway, it's an interesting overview. Thank you.
Yeah, Mr. Chairman.
Ms. Treasurer.
And this thing that Patrick talked about as far as that interest rate squeeze it happens in all industries. The next big one I think will probably be real estate, 3 years down the road. Patrick talked about terming out debt, where we're in pretty good shape as far as our real estate portfolio and our termed out, but there's a lot of, in the next couple of years, there's going to be a lot of companies out there when they have to refinance, they won't be able to do it. And I think there'll be some really amazing deals in secondaries. I think they're going to be hugely discounted in the private equity. So there's a lot of opportunities that are going to present themselves.
Yeah.
Mr. Chairman, Caleb is going to speak on private credit.
Good morning, Mr. Chairman and the board. Caleb Simpson, I'm an investment officer over private credit. Thank you for your time today. I know it's been a few weeks since we last spoke, and it's been an exciting few weeks. I've had the opportunity and the privilege to travel to New York and spend a few days on speaking to a variety of credit managers, as well as spending some time in conference there, as well as spending the last few days at the Milken Institute in Los Angeles. Okay, really what I've taken away from that is I think just a reaffirmation of kind of the thesis and how we've gone about building out private credit, and the continuity and continuation of kind of my thoughts of where we should be positioning as a state and as a portfolio going into this summer. Really, that's all predicated on all the hard work of Cheryl, Patrick on the fixed income side of the house, and just a team in general as we look at the broader markets and contextualizing the relative value and risks that private credit presents in the opportunity set that is currently there. As we've discussed, at these board meetings in the past, really where are we looking? Well, really looking to capitalize, Patrick touched upon this, on just an exceptional opportunity, which was really reaffirmed, broadly speaking, across most participants I spoke to at Milken as well as in New York. It is really kind of a once in a decade opportunity set in private credit to really kind of harvest exceptional yields without taking significant risk. Right now, a senior secured direct loan is pricing anywhere from 12 to 13%, right? So we're looking at the SOFR rate plus typically 650 for an upper middle market company and roughly 2.5 to 3 points of upfront fees. So you've seen 1 to 150 basis points or 1 to 1.5% of repricing in the spread over the last 6 to 9 months, plus an additional point of upfront fees. But more importantly, it's all about the covenants. So conceptually at a high level, really just to reiterate what we've discussed and what I've discussed to you over the last few months is really want to focus on core, regular way, senior secured direct lending, as well as asset-backed or specialty finance. So in line with areas which the board recently approved, in line with the Adelia, which the board approved last fall, and in line with Kennedy Lewis, which the board approved last fall. In addition to that, kind of barbelling and avoiding a lot of the mezzanine or second lien debt that is currently out there. You're just not being properly compensated for taking that getting that marginal extra spread for the additional risk, and focusing on capital solutions and distressed opportunities. The distressed opportunities are currently not present in the marketplace, but I'll touch upon why that's going to be such an interesting area to focus. So quickly, just to go back to regular way direct lending, and these are some of the things we've discussed over the last few months. As an asset class, it's an asymmetric asset class. We have limited upside and, in theory, infinite downside. And if you look at a lot of the structuring, particularly in the broadly syndicated loan market or in the bank market over the last 3 years, it's been fascinating to watch with the lack of covenant protections, the creditor-on-creditor violence that we've seen take place. So whether that's Chewy, whether that's, it kind of originated with J.Crew in 2016, was kind of this first example of what we call a drop-down transaction. And what a drop-down transaction is you get a minority of the senior secured holders to then drop down the assets, the valuable assets of the company, right, into a subsidiary that's protected and now super senior to the rest of the creditors. So they're holding majority of the creditors hostage, right? Well, there's the opposite side of that. It's called an up-tier exchange, in which a majority of the creditors then go and hold the minority hostage and take the assets and make them super senior as well. So there's a number of nuances and ways in which we will continue to see this play out due to the lack of covenants. So we need to be very thoughtful in not chasing that extra dollar or leaning into this space. So just given the attractiveness, on a net basis, on an unlevered basis, we're looking at approximately 10%, right? That's, an incredible opportunity set to help fund the regular way financing of the state without taking a significant amount of risk. In addition, some of the conversations I've had, you have software companies. We're not talking, nascent venture capital. We're talking large, established, positive free cash flow software companies having to come to market because there's not that private equity opportunity set, or there's not the opportunity set to go public in the current market, and needing to reach out and structure senior secured loans at 40 to 50% LTV. Some of the things I'm looking at, it's not just LTV, right? Because particularly in the private space, that's a lagging indicator, right? Those prices typically take a while to reset, but importantly, it's free cash flow to net debt, right? So if there is a prolonged period of stress, we want to ensure that these companies can service the debt, right? So that's key. So in addition to kind of the core regular way space, which is yielding exceptionally high returns, Kennedy Lewis was in the vein of a capital solutions. And then this summer, I'm going to be spending a significant amount of time and have spent a significant amount of time looking at stressed and distressed opportunities. Patrick touched upon this, but the maturity wall for the broadly syndicated loan market and the high yield market really kind of foments and will occur in 2024 and 2025. So any CFO that's worth their salt is going to have to start to look to restructure the debt here in the next few months. And the banks aren't there. The regular way bank lending is not available to all of the points Patrick touched upon. So it's going to be just an incredible opportunity to either provide, a capital solution or actually go and look, the classic distress for control that we really haven't seen for the last decade. So with that, I'll submit to any questions that the board may have.
Are there any questions? Great job, Caleb.
Thank you, Mr. Chairman.
Thank you.
Thank you, Board.
Thank you, Mr. Chairman. Next, we'll speak on the equity side. And just the reason that we're spending time and getting more into the details on this is we're going to ask you to increase our allocation in a significant way to the private credit market. And that's why we're kind of spending a little bit more time on that we would also. And I'd bet a wood nickel here that the next few years vintages of private credit will go down as one of the best that we've seen in ages. Seth.
And for the record, I'll note that Doug Dillard has joined us, so. Good morning. Go ahead.
I'm Seth.
Seth, good to see you.
What button do I push? Oh, we're good. All right. I'm Seth Consolver, together with Fong Zhang, cover equities. So I'll start my comments with just U.S. equities, which have been hovering sort of mid-teens from off their highs. They would appear fairly priced, kind of as Pat had mentioned, unless you were to assume there's a recession come around the corner, in which case it's easy to argue that they're moderately expensive. The recent earnings season has been a bit more positive than the last one, at least versus consensus, although there have been outright declines in earnings year over year. Analyst consensus is calling for further outright declines throughout this year in earnings, but we would say that equities, U.S. equities at least, would probably underperform in a recession, just given the modesty of the analyst pessimism at the moment. Europe, in comparison, as Pat had mentioned, appears relatively cheaper, more attractive, just from a valuation perspective, against the U.S. and versus historicals. Emerging markets are likewise cheap, although one issue with emerging markets has been the effect of China. China itself has weighed down the index about 40% over the past couple of years. And we do see several issues with China that call into question the viability of China as an investment, as a country to put your money. For this and other reasons, it's definitely not without its drawbacks to invest internationally, but just the valuation of international equities, I would say, is reflected in our view of being overweight to international equities. Preferred equities, that's the smallest space we cover that I think we'll talk about today too, but this has experienced a heightened amount of scrutiny over the past couple months with the turmoil in the banking sector. Preferred securities tend to be really heavyweight into financials, and especially with what we've been seeing in regional banks. Probably our bigger concern with preferred securities, though, has been the conditional securities market, the contingent capital securities market, pardon me. That's mainly in Europe. I think the experience with Credit Suisse, where we saw the contingent capital securities actually be placed beneath the seniority of common stock, calls into question the viability of the asset class. Certainly was alarmingly against convention, and calls into question that's 20% of the preferred security asset class. MLPs, it's the last space we cover. These are midstream energy companies, mostly pipelines. They've experienced really a renaissance in interest and activity over the past couple of years. A lot of this is related to the Russia-Ukraine conflict, the fallout from COVID, both of which have constrained energy supply and made those assets more in demand. Inflation also has just made these assets more favorable compared to other assets. But we've also seen management teams in the MLP space become increasingly capital disciplined, which has increased, in our view, the institutional appeal of the asset class. Dividend yields in the space are attractive as always. They range between 6.5% and 7.5%, with current pricing towards the more favorable end of that range. Our main concerns with MLPs would be whether there is a recession, how materially would energy demand be dampened. Of course, there are mitigating factors, years of underinvestment by E&P companies, and continued conflict with Russia. So that's it for my comments, unless you've got any questions.
Seth, are there any questions? Madam Superintendent.
Thank you, Mr. Chairman. Apologies, can you clarify if we're still overweighted in U.S. equities? Go ahead.
Yeah, we're overweight international equities. Yeah.
Okay.
Yep.
Thank you, Mr. Chairman.
Thanks. Further questions? I'll note for the record that Russell Reed has joined too, and my internet connection is unstable. So my hope is, and Mr. Treasurer, with your leave, what I thought we'd do is go through the presentation and then hear from the IFC, if that makes sense. Okay. I did have a question, Seth.
Yeah.
What % now is China of emerging market?
China's it's about 30% of emerging markets. Prior to the downturn a couple years ago, it was about 40%. It's just underperformed so significantly, it's now just a third.
And how are the rest of the tigers doing in that space?
So like Korea, Taiwan, they've been better than the index. Obviously, the index being weighed down by China. But I mean, if you were to compare them to U.S. equities, everything's underperformed U.S. equities for the past couple of years.
Yeah.
Yeah.
Where are they positioned now, though?
Oh, yeah. So Taiwan would be the second largest position in the EM index. I think it's probably about 15%, 12%, give or take. South Korea, I want to say it's about 8%, just to give you a rough feeling.
Okay, thank you.
Yeah.
And Mr. Chairman, we do have a topic after we're through with the other allocation to discuss our China exposure. And we do have a recommendation of looking to potentially change what we're doing presently because of the situation that we've been seeing in China.
Yeah, well, and I appreciate that. On that, Patrick, you know, and this goes back, I think, to when I was in the office. You know, we were trying to be select in how we were approaching that, knowing China was the big dog. But I still think we were concerned at the time about too much exposure to China in emerging markets, and we were really trying to be selective about that. So as we get to that, I'd love to hear a little bit more about that. Thanks.
Mr. Chairman, members of the board, Robin Preston will comment on real estate in infrastructure.
Morning, Robin.
Good morning, Mr. Chairman, members of the board. My name is Robin Preston. I'm a senior investment officer responsible for real estate and infrastructure. So commercial real estate has definitely been in the news recently. So if you open up the Financial Times or the Wall Street Journal, yeah, and you pass the front page is probably full of US regional bank stories, probably the same for page 2, but maybe page 3 or page 4, you will find some story. And it will be something like some equity holder will be handing back the keys to the guys who own the mortgage on some building. Now, typically, these will be investors. There's a variety of different strategies in real estate. So these transactions will be investors that have put a lot of leverage on the transactions, and it's probably low quality office. So to Mr. Treasurer's point from earlier, this is not what we do, just to be clear. So Patrick mentioned earlier that there will be, a lot of things come through from higher interest rates. So if we look at this, so you've obviously got investors that have a lot of debt. So the first thing that will happen is to the Mr. Treasurer's other comment, a lot of this debt was shorter duration. So as it matures, suddenly the interest rate on that debt steps up. And also funding using debt it magnifies returns. So in good markets, it boosts returns. And when markets soften, it magnifies the down moves. So these guys obviously have problems. That's not where we're investing. But we are seeing softness in commercial real estate. So there are two kind of ways this is coming through. The first is discount rates. So discount rate, this construct is used for all risk assets, equities, real estate, everything. So it's time value of money. So as interest rates go up, the value of risk assets should go down. And commercial real estate is seeing that. So what's happening is they use formulas to value the assets, and it involves discount rates, and commercial real estate is adjusting for those discount rates, and it's pulling values down. So there are certain subsectors where the rental income for properties are actually moving up. But in many cases, the impact of this discount rate is outweighing that positive, which is the higher rents, to pull values down. And you'll see that across all commercial real estate. The second factor is subsector specific, and that is office. So office leases are typically pretty long. So what's happened is you have COVID, you have a lot of people working from home, but the companies who are renting the office space, as long as they're still in business, they're still paying on those rents. But eventually these leases expire, and the companies are saying, well, okay, we don't need as much office space, so it's not it's not our problem anymore, and they're walking away. So that's increasing vacancy rates. So this is a sort of idiosyncratic issue with office. It's really hitting the lower quality office. To Mr. Treasurer's earlier point, that's not really where we play, but it does have an impact in all office. If you want to get workers back into the office, the strategy that's been adopted is you get a really, really nice, beautiful office. So that's holding up better, but the dark, nasty office, that's tough to rent out. So that would be the classic driver of markets like New York. There's a lot of very old office, not a lot of light. Chicago, similar. The Chicago real estate market has been a bit of a disaster across all subsectors. And then you have California. So California, it's not really the age of the office. The work from home dynamic has probably been as strong as anywhere there. And then there's also been the tech layoffs. So California is the other place. But lower quality office everywhere is problematic. So that's kind of, it looks like you have a question. Oh, I'm sorry.
I always have an inquisitive face.
So real estate, where it's been a tremendous performer in recent years, but it's underperforming now. And part of that is probably just a lag versus public markets. But we're definitely seeing some softness. But office will be more problematic. And then just touching quickly on infrastructure. So infrastructure, we're still rolling that out. That's still very new for us. So it's a risk asset. So it should be impacted by this discount rate argument. Interest rates go up, value of risk assets should go down. So we should see some negative impact from that. But the thing I'd like to just state here is infrastructure tends to be pretty defensive. So if we take the example of office, so people are moving out of the office to work from home and getting rid of leases. If you take a typical infrastructure investment like an electric utility, it doesn't really matter whether you work from home or from the office. You're still going to turn the computer on, and that's still going to take electricity. The electricity is a monopoly, so it's a much more defensive business model. So that infrastructure we feel should hold up better than real estate, but it's still going to be subjected to the negative effect of discount rates. We've also seen some FX volatility, and early in the investment process, you're unlikely to see managers marking up positions that they've just entered into, and hopefully you don't get too many positions marked down. So it's really just a little too early to sort of put too much weight on returns for infrastructure, but we continue to build that out. So that's hopefully a quick overview of real estate and infrastructure, and I would welcome any questions.
Mr. Treasurer.
Yeah, I had an opportunity about a month ago to go out and visit our offices in San Francisco. I was a keynote speaker out there in a real estate conference. And we have Google and Fitbit in one of our offices. And I can tell you that the folks at Google, very high participation rate of in-office employees. And that's because they know how to build office space and keep their employees happy. It's an amazing what they actually did with that old Schwab building. The other thing is that California, I think there's there's some regional aspects, I think, to investing in real estate that are going to draw a lot more attention as to the viability of investing there in the future. And I think we have to look at some of the ESG aspects, what California is bringing to the marketplace, because they're going to be substantial within the next 10 years. So we just have to have our heads out of the clouds and our feet on the ground when we look at future investments. But infrastructure, tell us about some of the infrastructure things that we might be doing in Wyoming.
Well, we've recently invested in a gas and natural gas liquids gathering pipeline in the PRB. So this is a continuation vehicle. A lot of investors are shying away from this type of investment for, let's call it, non-financial reasons. And we feel that that could potentially offer us outsized returns. So, we have the flexibility to still invest in those things. So we are actively looking at those sorts of investments. And it just so happened that an investment arose that was right here in our state. So we didn't invest because it was in the state. We invested because it was a good investment.
And so, Robin, just a quickly, that's a direct investment from the state of Wyoming to a specific company located in Wyoming. Is that correct?
Via an investment manager.
Thank you. Okay.
Mr. Chairman,
Madam
I
Auditor.
apologize because I ask this question at least once a quarter. Tell me again the four buckets that are in core.
The subsectors?
Yes.
Okay, so it's office, residential or multifamily, retail, and industrial. So we are underweight office and retail, and then you kind of have to be overweight the others. But then we also have overweights to life science, which is kind of like a hybrid office sort of laboratory, and a little bit of self-storage through our managers.
And Mr. Chairman, a follow-up. I know over the last couple of years, we have sort of targeted for lack of a better term, the Amazon, warehouses and boxes and warehouses and shipping, et cetera, et cetera. Is sort of the consumer softening that's starting to happen a little bit? How is that shaking out, or how do we anticipate that will affect some of those more targeted investments that we've made?
So that's a great question. So our largest overweight would be to the warehouse space. So I don't know is the very simple answer. The slightly longer answer is, in the last few years, the rents you got out of those warehouses, it wouldn't be unreasonable to describe them as unprecedented. So it's been a tremendous trade. And when I say about real estate outperforming the last few years, it's been driven by that single sector. And that's our biggest overweight. So that's been great. So at the moment, those leases are also fairly long, 5-7 years. So we have managers, one manager in the first quarter was renewing the rents for one of these warehouses, and they were saying that they were increasing the rent by 70%. So, part of that is like a timing thing, because, if the lease was 5 years ago and the world's changed a lot, but that's a tremendous positive. So you then try to work out the valuation, and then you apply your sort of discount rates and stuff. So you've got that as a big positive. But we are seeing, when you hear about what Amazon is doing, they're kind of pulling back. We've got this discount rate issue. So it's kind of like the interplay of the two. So we feel that having this kind of this potential to raise the rates a lot. You know, that can change, but at the moment, the rents are still going a lot, gives us a lot of cushion. So we'd much rather have something like that, where you've kind of got this locked in future cash flow than office, where if anything, the rents are probably going down.
And Mr. Chairman, I guess I would also think that even as consumer spending, even as that softens, I would think that the percentage of online, continues the trend of going up versus, so those, okay, thank you.
And another popular argument that you hear, and I think makes sense, is everybody wants their stuff sort of quicker. So you have this kind of logistics network. And the argument is by adding warehouse space, you can reduce the amount of trucking that you have to do. And the cost on the trucking side outweighs what you pay on the infrastructure.
Thank you.
Anecdotally, what I'm also hearing is that because supply chains have been so troubled, people, when they get something, they get two of it, so they have something on hand, so it's maybe a bit of a bump. I had a question vis-a-vis, I'm trying to remember if it was SC Capital and what it was doing in Asian markets, how they've performed, and then I also wanted to talk about London and what's happening there.
So yeah, SC is it's troubled at the moment. So SC is our Asian, it's a multi-sector Asian Core Plus fund. They haven't handled liquidity particularly well. Like UBS, they've got an exit queue. You can debate what the right approach is. Like some people kind of take the pain early, and some people say, well, I'm going to sort of sit tight and hope the problem goes away. The problem with the latter is if it doesn't go away, you've now got a bigger problem. So SC, it's got some problematic Australian office. We talked about office. I think the rest of the assets are reasonably okay. They kind of missed the industrial kind of rally that everybody else caught. When you look at the returns, the biggest problem is probably the FX, which isn't really their fault. So we've been whipped around. They had a horrible year last year, but that was really just due to the FX. They have a kind of a partial hedging, which is kind of a strange thing. It's easier to sort of handle those things if you're either totally hedged or not hedged at all, but this sort of will hedge a bit is tough to kind of figure out what's going on. So they are, that's kind of that's a bit of a mess. It's 100 million, so it's a meaningful number, but it's relatively small compared to our main positions. And they're trying to figure out what to do with their fund. It feels like their commitment to these open-ended vehicles is probably waning a little bit. So not a great story.
Mr. Chair, can I just add on a couple comments on that one? Our view is that it's more of a manager-specific issue as opposed to sector-specific. So for instance, they wanted to raise their leverage. We said, voted absolutely not. We got outvoted. We wanted them to sell property. They said, yes, we're going to sell property. They haven't sold any property. So this is something that, and so what have we done? We said, we're going to redeem. Talking to our consultant, everything else, if we put in the full amount, that would scare any potential investors away. So we said, okay, we're going to redeem at least a third, and we're in the process of trying to redeem the entire amount. But this is, in our view, much more of a management issue as opposed to, well, every real estate company is stressed across the world in certain instances, but this one has been magnified because of some questionable calls by the management.
Yeah, okay. And London, just really quickly.
Sorry, what is?
Well, I just was curious what's happening in London market.
Oh, so so our first infrastructure investment is with Macquarie, and Macquarie has decided to, instead of doing separate meetings in the different continents for the different funds, they decided to do a global meeting. So this will be a chance to go out. The LPAC will be held out there. We'll also be seeing a data center asset and possibly a utility out there. And it's a great opportunity to meet a lot of experts in the space. So obviously, we're still trying to learn about the infrastructure space.
Okay.
Oh, does that answer your question?
That's good enough. I can catch up later. That's fine.
And so a lot of the infrastructure funds are global, though.
Yeah.
So we have UK assets.
Yeah.
Unlike is the case in most real estate.
Yeah. Okay.
So now we're getting into the meat of the discussion with Josh. Just to,
Okay.
Well, thank you, Mr. Chairman. Can you talk about specifically some of the deals you've done in the last year, other than you talked about that natural gas deal earlier, but I mean, what have been some of the ways you've effectuated some of the regional challenges that you've discussed over the last year?
On the real estate side?
Yeah.
So real estate is a little tricky because when you get times like now, many of the funds restrict redemptions. So unlike equity or public fixed income, it's very hard to move things around. So what we've done recently is so we talked a little bit about the four main groups, and there's kind of, you can say, industrial looks a bit scary because it did so well. You can say multifamily is kind of like, there's always new stories about multifamily. Retail's been a disaster. Office is going to be a disaster. So we've been looking at niche kind of sectors. So one investment which we've committed to, but we have yet to fund, is medical office. So in this case, it's basically renting out the real estate for hospitals and doctors and things. So that's a nice way to get exposure to subsectors which should be less cyclical than things like office. So that's one of the things we've done. It's tough to do too much just because you have to get money back from one manager before you can give it to another.
Anything further? So, Patrick, if we're going to start to go into this, I didn't know if you wanted to have any of the members of the IFC just say something quickly, or?
Sure, that would be great. I just, in conclusion from what we're looking at, one thing I just want to clarify, when we're talking about private credit, we're also talking about distressed. And so one thing, we always talk about the positive side, and now that Doug has joined us, I would like to have him comment on some of his comments during the meeting about some of the potential negatives of into the private credit side. But one area that, mitigating some of it, one issue that he has is just the opportunity set within private credit and distressed. There's going to be a significant amount of assets, in my opinion, that's going to come into this sector. On liquidity side, I'm part of a Milken advisory group meeting that controls 28 trillion in assets globally. And in a conference call we had before meeting and further conference or meetings that I had this weekend, they asked about, okay, all of you have spending policies like us, actuarial rates or what have you, that are 5.7, whatever number is. And they said, now that you can lock in these rates at 8+, Michael Milken said, okay, with a ag private credit, you can have fixed income rates at these levels. How many of you are going to do that? And not one person raised their hand. And they said, well, why not? This is exactly, you could, go vacation for 10 years. You're going to be fine. And vast majority of them do not have the liquidity to do so. And that's the issue that we're facing. The other side of it is in the private's valuation. And I just want to make sure everyone's aware of the difference in the valuation. And Josh is going to talk about this. But what we see for the marks, many of these managers do what I call mark to make believe. And part of it is because we haven't seen the transactions to actually warrant it. So I asked PIMCO to go out into the privates and said, okay, go out of all of your contacts and price the difference between public and private sectors. Venture capital, public marks versus private, down 9%. Private debt, down 10%. Private equity, down 20%. And real estate, down 37%. So some of the arguments would be is like, well, why don't we go out and buy REITs at minus 37? And we've actually, in the opportunistic bucket, have looked at this because that is the liquid asset that people can sell. So boom, 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 you bang them down. Is that accurate? I would say no. But is it down significantly more than what we're showing from the marks? I would say absolutely. So I just want everyone to know we're fully aware of that. And when we're looking at new investments, we're not buying at market rates. So we're getting discounts upon the discount. And so just to be clear on where we are. So with that, pass it back to you and the IFC, Mr. Chairman.
So, Mr. Diller. Right, there you are.
Okay. Well, I get my answers to questions which are changing daily, given what's happening with our community banking system and everything else that's going on in the world. I guess the biggest concerns I had is really more manager specific than sector specific, Patrick, if that's what you're referring to, and that a lot of these funds, and not just in private credit, this is true in private equity and venture as well, are raising such large funds now relative to their historical sizes of their funds that I'm just wary that that'll cause them to do things that outside of their historical comfort zone and strength and lead to maybe some outcomes that aren't as favorable as you would expect given their track records. That's the biggest concern I have on just the private credit, but also private equity and ventures world. Having said all of that, given what's happened in the banking system, there's going to be a lot of opportunities in the private credit side that are, I think, going to be really unique in the next few years while we figure this out. So I guess that would be a little bit more of a balanced approach than maybe we talked about last time, Patrick.
So, Mr. Chairman, yes, that was his concern, just because of the massive amount of money that's coming into this sector, and it's really a manager specific. Do we really feel comfortable? And we've been trying to. We definitely do it in the private equity sector. We do it in the hedge fund. These funds that have just gone from $1 billion to 30 billion. We want to stay away from those.
And you start chasing deals and all kinds of stuff. So that's a
It's a
That's a
big
real
concern for us. And so Doug is spot on the manager specific, that we should and need to be very cognizant of, do they have the infrastructure? Do they have the background in all of the private markets to handle additional valuation? And then it opens up a whole different tier of managers in the distressed area. So that's the kind of mitigant of that we're also looking at. And just real quick, Mr. Chairman, I'll be very quick on this. I want to just highlight and thank all of you and the IFC, because so many of these opportunities that come about, we're not able to take advantage of. And the beauty of this is that we've set up this to be able to take advantage. So we can take advantage of distressed in private equity. There's distress there. We can take it in private credit. We can take it in real estate, and we can take it in hedge funds. So if we miss out on this opportunity, it's because of me, not because of the opportunity set.
Great. And I see both Ken Lay and Tom have come alive suddenly, and so has Russell. So good to see you all. Is there anything in particular, Patrick, you'd like them, or can they just opine generally? I know, Tom, you were getting excited when we talked about emerging markets.
Yeah, and I would say, Mr. Chair, that it's changed a bit because of, frankly, as Patrick alluded to, the Chinese situation. I've never seen in my career sort of an about face of thinking about, kind of a China approach, frankly. And as Patrick and Caleb alluded to, being down at the Milken conference, I would say that was pretty much the feeling of most investors of, how to approach it in terms of China. One thing I would say with the private credit, and to sort of highlight Doug's comments, there is no question that everybody is piling into private credit, without a doubt. That is the place. And so to me, it really does opine with Doug and his comments on active management is going to be critical in this circumstance. And so in a way for us, because we're actually relatively smaller than a lot of the big players, that we have the ability to be able to really try to find the best and brightest managers. And so I would just highlight one of the things we've seen with private markets, with private equity, with private credit, is we look at historically at their fundraising. And generally, when they're fundraising a lot of money, the vintages tend to be not as great. And so that's why we really do need to make sure that we are, I think, looking actively and making sure that we're really doing well in our manager selection. So thank you, Mr. Chair.
Yeah, and Tom, just your opinion, China has just run EMD forever.
Yep.
And there have been opportunities outside, if you sort of were agnostic about, or actually ex-China, there were some pretty remarkable opportunities. And I don't know if you got any ideas on that.
I think, Mr. Chair, what's interesting is there was definitely a debate on whether or not Hong Kong is back. And I would say half the room felt that Hong Kong was kind of coming out of it and really making a play to sort of be a, powerhouse again, while another half was still thinking it was a little bit of a sock puppet still for the PRC. You're absolutely right when it comes to sort of the China derivative plays. Singapore has done incredibly well. In fact, Singapore at the Milken conference was all over the place with their tourism, government, Temasek, GIC, et cetera, there. So they're certainly making a big play. Taiwan, obviously, I think there's a little bit more concern, given the geopolitical elements that are going on there. And then, remember, India now has passed China in population, right? So India is now the largest country in the world. And so there is a little bit of this discussion of, is this India's moment? And I will say one other thing, just not from the emerging markets, but Japan. The other thing I thought was interesting, I wasn't expecting it, was sort of with the new government in Japan that's saying that this is really the opportunity set in Japan. But I think, Mr. Chair, you've seen this where, everybody gets very excited about Japan, tends to go over, nothing really happens, and then they move down to the rest of Asia. So I'm not sure I'm fully convinced with Japan. But it is very interesting, though, certainly on the Asian emerging market side, that, Modi in India is certainly big opportunity. In fact, talking with the Slib, Wisconsin, talking with some other folks that, they're making a pretty big push into India.
Thanks. Russell, I see you're off mute.
I am indeed. So really want to underscore quite a bit what Tom mentioned. India is definitely the geography du jour when it comes to the private markets for a couple of reasons. So that shift, sort of out of China into India is on everyone's mind. It's true in venture land and it's true with infrastructure. So I think that pivot is a real one, certainly one in which the institutional investors are kind of refocusing. So that certainly is something I've been hearing, not only in India, but I was just in Korea earlier this week at their venture capital association meeting, and in the Middle East. So I'd say the shift toward India is coinciding with that. Being a growing population that's now bigger than China. But it's the other theme that has been coming through is that after years of dollar strength, there is a growing belief that the strength of the dollar will be, ebbing, and that so we might have might have hit a sort of a cyclical high. What that will do is that will, after several years of U.S. assets outstripping their international counterparts, that could point to a good time for international diversification.
Interesting, thanks. Ken?
Yeah, I would just second what the others have said. Just to come back to a point that got raised earlier, Mr. Chair, and that is that I think with the emphasis on the less liquid private assets, I think it's very important that we pay close attention to the valuations, the marking, all of that, because I think there's a significant risk of uncertainty in this area, and I just think that there are people who have different incentives, let's say, as that process unfolds. So that's that point. And I think also the point that others have made about the rush into this, into these areas also carries risks. So I think the Slib and all of our stakeholders should simply be aware that and be prepared for an increase in a potential increase in volatility across our whole area as we go forward. That's not to say that we don't seek to take advantage of these situations, but we should be, I think, aware of that potential so that we don't get taken by surprise.
Thanks. Any questions?
Yeah.
Okay,
I think now we're,
Mr. Secretary, and then I'll treasurer it.
Mr. Chair, it seems like we've kind of gone into a little bit of a macro discussion, which I appreciate. And Mr. Lay, your volume, it's been a little difficult hearing you, just to let you know. But I wanted to ask you a little bit. I mean, we're entering in the next month. The one thing that has been shown to lead to a reduction in expenditure, which is the leverage that's brought by hitting the debt ceiling. And do you have any, and maybe this relates a little bit to the gold discussion later too, but do you have any concern of a sovereign debt crisis, especially in light of the reserve currency status, that the questions on that were mentioned earlier? Or do you think that the folks that have been talking about this for 40 years, and I'm one of them as long as I've been an adult, that it's just always going to be a thing in the future? Or do you think that we're coming time here where these bills are going to come due and we're going to start to unfortunately see the consequences of just this lack of discipline at the federal level?
Who wants to take that on?
Not it. No, I'm just kidding. I will say, so Mr. Secretary, I did attend a panel yesterday at the Milken Conference with Mick Mulvaney and a couple congressmen, discussing kind of this very topic. And well, I have to admit, it was discouraging because, frankly, there was really not many conclusions, frankly, from it. That it just, I guess, it has become so partisan, on both sides, frankly, of trying to come to some sort of agreement, frankly, of kind of how to approach it, because I am concerned with that. With sort of the strength of the dollar, et cetera, on a much, much bigger basis. But on the flip side, I would say, and I would encourage, and I can certainly send this article to Patrick to send to everybody, but The Economist had a great article on, don't underestimate the United States in terms of its economy and where it is. And so it kind of gives you, I guess, a bit of a confidence in terms of the growth elements, the demographics of the United States, et cetera, et cetera. But certainly from a political standpoint, I guess I would tell you that, yes, I am concerned, frankly, just in terms of trying to be able to tackle this particular problem. So I hope that, I know that's a very 80,000 foot sort of answer, but I hope that's helpful.
Russell.
I think what I would add is that, the specter that we've had of inflation is something which may not really go away very quickly. I think the Fed is very concerned about it. I think the amount of debt that we have is on the federal level is it's mimicked by a number of other large economies, such as China. So it's not that we're the only ones carrying a very large debt burden. Japan as well, and that is raising a prospect, at least on a tactical level, for a gold allocation. So gold is a terrible long-term strategic asset, but tactically it can make sense in the portfolio. And I know that a number of institutional plans have been taking a tactical tilt toward gold more seriously.
Very good. Thanks.
One thing I would just counter to that a little bit on the inflation side is I've been at a couple of my private equity fund LP meetings the last few weeks, and companies are cutting much more costs than people think. And AI is really moving very quickly and allowing call centers to shrink. Like, there's a lot of, I think, job dynamics that I don't think are really understood yet. And these are mostly private companies, but large private companies. Just to give you an example, one of the companies is cutting a third of their workforce, which again, and they think they can do it without missing a beat. So that's a whole nother level of productivity and deflationary pressure that I don't think is in the conversation yet. I know everyone's talking about AI, but it's actually now starting to play out in reality, in actually making companies making decisions. So I think our conversation a year from now is going to be more about deflation, not inflation, in my opinion.
And Mr. Dillard, you raised a really interesting point. The Fed's dual mandate is going to be truly tested at this point. You're going to have real labor participation. You already have real labor participation effort that's going to make it difficult for them to deal with that. Plus, then they also have to deal with what the interest on the debt is going to mean to the overall economy. All of these things make the Fed's ability to act independently really pretty suspect.
Mm-hmm. I agree.
Ms. Treasurer.
Yeah, Doug, one of the issues that we talked about, I think, just very briefly in the asset allocations, but that I guess I'd call you the subject matter expert on it, is venture capital. And I didn't know whether or not in this atmosphere that we're in now, whether or not there'd be any opportunities in VC as there are in other areas, and what your general thoughts are on venture capital, and as far as within the next now or within the next 3 years.
Well, it hasn't changed. I mean, I think there are going to be some great opportunities, but I can tell you everyone's pretty much sitting on their hands right now and dealing with their existing problem children, and structuring the structuring that's going on of new investments is unlike anything I've ever seen. So the hooks on new capital going into companies are pretty broad and deep. So I think it's a great opportunity. I think it's going to take a while. I think there's going to be, as we've talked about before, private credit obviously is going to be a big opportunity, but everyone knows that. I think venture is going to be. I think this vintage is going to be good. If you look at the last, like 2021, the number of investments that were made on the portfolio levels of all the different venture capital firms is incredible. You can't even fit the logos on a page in all these presentations. And so I think you're going to have, kind of a while where the recent vintage investments are not going to look very good. But I think investments that will be made over the next few years could be very attractive, especially given the nature of the structuring that's going on and a lot of the downside protection some of the smarter managers are putting in their new investments. But I think private equity is even more interesting just because you have some really big, large, profitable companies that, I think there's going to be a big take private opportunity on the private equity side over the next, 12 months, which is probably the more near term interesting opportunity.
So, follow up, Mr. Chairman?
Sure.
When you say the hooks in venture capital, does that mean that there's going to be some very, I guess, put it in the way that some great covenants that you might be able to extract from the process?
Yeah, there's just a lot of downside protective covenants that folks are putting in the deals so that they're just much more attractive than things you could have done, 12, 18 months ago. And that's just based on the environment we're in. The scarcity of especially for real venture capital. I mean, this is, my portfolio companies, not one is hiring right now, like literally not one. Actually, that's not true. One is hiring out of 30 companies. And the rest are in, cost-cutting modes of some sort.
Okay, thank you.
Thanks, Mr. Treasurer. Well, I'd love to keep this conversation going, but I know we have Josh here and I know we have limited time. So without objection, Josh.
Thank you, Mr. Chairman, members of the board. Josh Keevan with RVK. If you have our presentation, I'm going to start on page 3. But before I jump into that, I just want to start by underscoring something that Patrick said at the beginning. We concur that this is the most important decision that you make as a board as it relates to the investment results of these funds. Just to give you a recent example of that, just going back 2 years ago, this board made some pretty significant adjustments to strategic asset allocation that were largely rooted in the fact that interest rates had gotten so low that bond yields were so unappealing. And conversely, equity prices had been pushed up so high that those prospective long-term returns were so unappealing that the focus at that time was to really diversify. You moved out of traditional bonds in a pretty big way. You went into more heavily into some diversifying assets, things like you heard about the midstream energy investments, the infrastructure investments. You moved in a larger way into floating rate investments. And we had no idea. I mean, this is rooted in long-term thinking, long-term vision. We think getting the short-term right is very difficult to do consistently. And to try to do that can actually be quite dangerous. We had no idea that that would prove to be so beneficial so quickly. The first year of it didn't really matter too much one way or another. But last year in 2022, you had global equities down 20-ish% and safe bonds down 15% at the same time. That hadn't happened since the early 1980s. To see that level of correlation between stocks and bonds down double digits in the same year. You had losses, but you had very low levels of loss compared to traditional financial markets. We've talked about that quite a bit in your performance reporting. So I just want to underscore how important this decision is. And I also want to underscore that, most of the conversation we've been having is, or not all of it, but some of it has been a little bit more near term. And I just want to underscore that, our thinking and the science that's behind this is very much oriented towards the long term, which we think is the right way to set strategy in your policy. And then the tactical decisions that get made around that policy, that's what the investment team is responsible for executing for you. So if we go to page 3, I'm going to summarize the recommendations that we have for you. These are the recommendations that came out of about a day and a half of very good discussion with the investment team and the IFC back in March. And starting on page 3, we have a summary of the recommendations for the permanent funds. And currently in your policy, as you know, you have 2 types of permanent funds. You have the long-term total return focused funds, the largest of which is the Permanent Mineral Trust Fund. And you also have the income focused permanent funds, the largest of which is the Common School Permanent Land Fund. On the graph, on the bottom left of this page, you see the efficient frontier is that green line. That's the result of our inputs as far as expected future returns and risk and correlation of the assets. And it's optimizing for, at every level of return, how do we achieve that expected return with the lowest amount of risk? And you can see your current policy targets for the total return in blue and the income focused in orange. Both are on that efficient frontier, but you do see a pretty significant gap. The income focused fund has a lower expected return and a lower expected risk. It's primarily driven by its income needs. It has a higher guaranteed distribution rate. And if you look, actually, if you look at the yields on the table on the right, you look at the lowest number there, you can actually see the projected yield. Even though it has a lower expected growth rate over time, it has a higher current yield, current level of income, over 5% versus 3.7 for the PMTF. The recommendation at this point is to actually consolidate these funds into a single long-term endowment portfolio. And that recommended portfolio is the green square that says recommended target. So it's a smaller move for the Permanent Mineral Trust Fund and other funds with that asset allocation. It is a larger move for the income focused funds such as Common School.
And Josh, just for a little bit of historic perspective, that we're moving back to where we were when I became treasurer. We had one allocation for permanent funds. The treasurer, when he was in the Senate, made the point over and over again that when you spend your capital gains, the growth that comes out of the fund is from the severance tax, not from investment activity. And he always pointed that out with me and with say the Treasurer Lummis and Treasurer Meyer as well, and he was absolutely correct. The reason I made the recommendation to break the two was because our school funds needed to have income, and I don't think capital gains are the same as income. But I think the issue that the legislature brings up is that we should be able to spend it. Normally, in a trust situation, there are trustees who make decisions about how much of that should be spent, and they can, in an endowment model, which we don't really have, we can get closer to an endowment. We'll have to change our active admission. We'll have to change our constitution to really come to an endowment model. But the challenge that we will still have will be that the beneficiaries are going to be the people who are acting as trustees. And that's a challenge. And normally in a trust, you have trustees who are making judgments, not people who are saying, I need to spend this money. So I fully support this move. It was an academic exercise on my part. I'm glad it yielded more over the last couple of years. I think that's been good for education. But we are, we're taking a loss in total return. Although that total return as expressed is not necessarily going to be more money because we'll be spending it.
Mr. Chairman, if you think back though, 3-4 years ago, yields were not as high as they are now. Right. So it was a constraint on the Common School Fund that prudent investing called for addressing. And so it was the right move at the time. There are some things that have changed, though, that I think make this a good time to make the move back the other way. And that is just the upward movement in yields. This recommended target here has an expected yield, just using market data, of about 3.9%. A year ago, it would have been several hundred basis points lower than that. So, we've closed the gap on the 5% distribution rate. The other thing that's noteworthy here is in the most recent legislative session, the increased size of the reserve funds that help cover that gap in years where natural income doesn't provide for the spending policy amount. Those larger reserves will also help facilitate this consolidated one portfolio, highest total long-term returns, highest risk-adjusted returns. So.
Yeah, Mr. Chairman, and the only way that you can do that, and not just by your contributions, so you have an inordinate large return like the 1 year where it went over 23%. But when I look at the endowment structure, and I hope that we move to that, there was a piece missing, and that was that piece that allows you to continue to compound and not spend that, and that's where that generational fund that we're contemplating, and Josh and I are going to whiteboard that this afternoon to see how that would work. But essentially, if you get a 12% return, which I think you can in that type of a fund, you double every 6 years, $2 billion in 24 years would be $32 billion. And then strip 12 billion and put that into the constituent funds that contributed to it. And then in another 24 years, you start with 20 billion, you got 320 billion. And then that allows us, I think, to do the endowments and not worry about ever spending it down to zero, which could possibly happen in an endowment structure, but actually have that backfill structure. And then at the same time, we're taking into account of being able to offset the reductions in mineral income that we're going to have over the next 50 years. So,
yeah, and I think I think you're right. I mean, it is interesting that currently with the permanent structure, we do have supposedly a floor, although we have at times obviously invaded that. We have spent corpus by the virtue of the fact that there have been capital losses which reduce the corpus, and yet we've kept our spending that way.
Yeah,
we don't treat gains the same way as we treat losses, and that means that we have a one-way valve that has allowed us to spend corpus in violation of the permanent nature of those standards.
When you have severe market reductions. So I think that as we move toward that endowment, I just wanted to make sure that we did two things, that we supported the endowment structure, so we have guaranteed income that goes through in our current funds, but then replace our mineral income in the future, so we can rely on investment income rather than mineral income.
Very wise, very wise.
Mr. Chairman.
Madam Superintendent.
Thank you, Mr. Chairman. I'm quite intrigued by the increase in private credit and just kind of, want to dig into that a little bit more. You'd mentioned that kind of our summary is really that long-term look. Do you see the duration of investment in private credit to be long-term, and how does that kind of fall on the risk tolerance scale? And if the Fed keeps, tightening up on that monetary policy, what will that look like long-term?
Mr. Chairman, Madam Superintendent, excellent question. Yeah, you're seeing the difference column over here and how much the big areas we're increasing, the biggest of which is private credit, going from a 5% allocation to a 10% allocation. And this would be also true of private equity, which is going up to 15%, and infrastructure, which is going up 3%. Those are the big increases, are the private markets, the biggest of which is private credit. And an important aspect of this that we wanted to make sure we were clear about today is that it will take a number of years to actually reach these targets. And we will have, if this is the target that the Slib is comfortable with, we will be back for your June Slib meeting with the appropriate policy edits that would allow for this, but also a roadmap for how we see getting here. And so you heard from a couple of the IFC members comments on vintage years. There are some years that are great years for private markets. There are some years that aren't quite as good. It's hard, it's a little bit challenging to know which are going to be the really good vintage years in advance. It's of course obvious in hindsight, but one of the ways to mitigate that is to not make too much of a bet in any one vintage year. So we're going to want to, develop a pretty methodical and thoughtful plan to phase into this over multiple vintage years. And along the way, we will have more conversations about asset allocation. So even though this is long-term, it's not that we just set it and forget it. We want to be moving in the right direction, but we also want to take, if you think of this journey of allocating the permanent funds as we're on a hike to a journey. We want to stop and check the map every now and then, make sure we're still going where we think we need to be going.
So I think the superintendent brings an interesting question that we should bear in mind too, which is just liquidity. And what Patrick's comment about mark to make believe, private equity valuations, they're great to have in a portfolio because you always make your returns look awesome no matter what the market's doing, because they're longer term. Then there's hell to be paid when it's over. So I think the superintendent, really good point.
Mr. Chairman, could I just follow on?
Yeah.
Yes, Superintendent, the other comment that I would like to make on that is if you look at bank loans and you see the -3%, so not just take it in, one part of it, but one thing that we really are skeptical or nervous about bank loans, and part of that is because the covenant light structure that we've been seeing, but also just the credit quality. So over 50% of the bank loan index now is single B. It is really deteriorating. High yield is a better credit quality than bank loans right now. And so what we're doing is we're very similar type of returns that you get. If you want to go floating, fixed, we can even do better, but you're moving up the capital structure there. So you're going from a, unsecured in somewhat, or secured, but a very questionable secured position to a senior secured position with very good LTVs. The credit quality is dramatically different between the two. And so you're saying, well, that's too good to be true. What do you do? Well, what are we giving up to be able to do that? And primarily that is liquidity. So anywhere from, 3 to 5 to 6 type of years, you're locked into the bank loan structure, as opposed to we can sell bank loans within a month. But we think, and that's the beauty of where we are right now, is we have the liquidity. All these other people you talk to, it's like, what do you do? What do you do? So thank all of you and the IFC that we're in a position to take advantage of this, where, as I said, $28 trillion of assets are not. So, as you can tell, I'm more excited now than I've ever been in my 8 years here.
Mr. Secretary.
Mr. Chairman, I'm very supportive of combining these approaches, and I wanted to ask a little bit about the common school account, CSPLF. I've always viewed that as pivotal to what I believe has been the overall strategy on these permanent accounts since they were created, which was to use the mineral wealth that God has blessed us with to keep our tax structure, to have an intergenerational equity, but also keep our tax structure the way it is, understanding that it's a non-renewable resource that's being extracted. And the CSPLF is pivotal to that, because our main deficit, and it has to do with the structure of what our main deficit is, always in the school foundation program account, and the Permanent Wyoming Mineral Trust Fund usually doesn't back that up. And there's a lot of emphasis on the Permanent Wyoming Mineral Trust Fund, but it really is not, I believe, achieving the central goal of these permanent funds, at least when they were created, and my goal, one of my main goals with these funds. So, I know we're combining the portfolio approaches, and I think that's good. It looks like it's good. We're going to get more returns. But my question is, this concept that I know at times I've heard the CSPLF is not as much of a focus of the IFC, and this is in no means an attack on the, but there's a lot of talk about the permanent fund and it's everywhere. But is there what I've heard is there's a certain level we need to hit. That's for us to maximize the returns in the CSPLF, and it's just not high enough. So do you have a number we need to hit, that the legislature needs to hit to make it basically, I mean, I understand we're going to have the same approach, but in terms of the returns as a percentage of assets for us to basically mimic the permanent fund, and hopefully then have it emphasized equally in our discussions. Thank you.
And Mr. Secretary, just a little bit of background. I think we'll go into that risk analysis as we do that. We'll go into a higher risk kind of deal. The point of what we did with the income yield was to do what the Common School Fund was meant to do, which was to provide income to offset taxes. Returns are not income. Returns are another measure. They can lead to higher income, and that, I think, is the issue that's before us. And so that, but again, it comes down to, in a normal trust position, there are trustees who have the ability to invade parts of the corpus to make up for losses in anticipated income. We tried to set that up with our spending policy accounts, but that's where you treat gains different than income under normal circumstances. If you consider gains, which has been a long time discussion about how do we profile capital gains so that we can spend in anticipation of the gains we're going to get, you can see the risks that are associated with that. And I think that's the reason I make this plea, is that there is prudence here, because if you focus entirely on returns, you're going to go out on a risk profile, and it wasn't that long ago that we had to rely on our coal revenues to make up the losses that we had. And we performed much better than most funds further out on the risk because we were so conservative at the time. So, but I understand your point, but I think that's part of this discussion as we go forward. If you are going for a total return process, you need to also have the discipline around that to make sure that you realize the benefit of a total return.
Mr. Chairman, Secretary, I would actually point you to a couple pages later in the deck, starting with page 24. Even though it's a little bit later, I think this is a good time to address that question, because there are some things as far as what do these returns mean? What are the goals of these funds? What's the probability that we meet those goals? And so one of the things we do to test that is a more sophisticated modeling of the range of things that can happen with different investment portfolios. This is a Monte Carlo simulation that essentially goes out and it takes our inputs, but it also looks at, okay, for equities, the distribution of equity returns from one year to the next. It's not really normally distributed in a nice, normal bell-shaped curve. We know that there's this fatter left tail. The bad years in equities happen more frequently than the standard asset allocation models would have you believe. So we think this is a better way for us to evaluate what downside risk looks like, as well as what's the probability of meeting certain return levels over different periods of time. So that's what this shows you over 1, 3, 5, and 10 years. And so you've got the recommended target first, then you've got the two current policies, which are the blue and orange. And first of all, there's a couple different things on risk that I want to touch on here. In statutes, your legislature has written into statute that your risk on these funds shouldn't be more than the risk of a portfolio that's 70% equities, 30% bonds. And so you can see on the far right that global 70-30, that's what that portfolio is. 1 year first percentile downside. So this is like a really bad year. If we ran 1,000 scenarios over a 1-year period with a 70-30 portfolio, 99% of them were better than this first percentile. So you can think of this as a pretty good stress test for downside risk. Loss on that would be about 32%. That's about what that was in 2008, 70-30. For the recommended target, it's minus 18. So you're well within the statutory guidance here. The other thing that's currently in your policy is a risk measure that says these are to be managed with a goal of avoiding 1-year losses greater than 22% with 99% confidence. So that's the other place that we check this. So 18, still also within your policy guidelines on risk. Okay, but your question was about long-term goals and objectives and meeting the purpose of these funds. And so you can see we also run this out over the next 10 years. That's the bottom one. And you can see that the 50th percentile, which is kind of the sort of base case, of the thousands of scenarios, this is the one that's right in the middle. 50% odds that it's higher or lower than this. But we see an improvement for the income funds, which is the common school, of about 0.4%, going from 6.8 to 7.2. So we're staying within the risk guidelines, but we're improving the projected returns by a pretty material amount. I know 40 basis points may not sound like a lot, but you apply it to the billions of dollars you're responsible for. That's actually a very large number. On the next page, we translate this into probabilities of achieving certain real returns. And when I say real returns, I mean after inflation. And this really gets at the heart of the goal of these funds. Your spending policy is 5%. So if you think about meeting the goals of these funds, you need to earn your spend rate plus inflation. So you need to earn a real return of 5% over time. For the recommended target over the next 10 years, this portfolio has a 45% probability of achieving a real return of 5%. Now it's not 50, and when you do this kind of exercise, you would want to ideally see at least 50% probability there, but it's a significant improvement from the 37% if you kept with the current. The current asset allocation for the common school fund, it will do a great job of meeting the income needs for the next year or two. It doesn't do as good a job of meeting these long-term objectives. And if you can ultimately grow the portfolio more, that does mean more income in the future because the pie is bigger. Now you could take more risk. You say that's not a high enough probability. Let's take more risk. Let's push more out into equities. Well, you can, with the way that the markets are sort of priced today, you can take a lot more equity risk, but look at that 70-30 portfolio. That's 70% public equities. Only got a 36% probability there. That's because it lacks the diversification that you've built into your portfolios.
Mr. Chairman?
Mr. Treasurer.
Yeah, Josh, I wonder if it, on the next one we do here, can we do what the interest rate would be at a 50% probability in each one of those years? And then that would give us an idea in setting spending policy if we wanted to do, make sure we at least had a 50% probability. It might be 4.75 might get us there, there on all of them. So if we had a 4.75, we'd be 50 or above on all of them.
Yeah, Mr. Chairman, Treasurer, that we do another study that you've seen, the intergenerational equity study, which I think gets at that sort of, which is more kind of a break-even concept that you're addressing. The one thing that does show up in that when we do that intergenerational equity study, where we actually bring in your projected cash flows both into the funds and distributions out, is your funds have been growing because you have cash flows into them. And when you actually run that analysis, the 5% ends up being kind of a simple way to look at this. If your fund is growing, because you're averaging your distribution over multiple, the market value over multiple years, the effective distribution rate has actually been less than 5%. That's true as long as your funds are growing. So that's actually been something that's helped you sort of through this period of lower returns. But the only caution I have on that is that can turn the other way too. If your funds are not growing and they reach a point where they're large enough that distributions will outpace the inflows, it can work the other way too. You're not quite there yet on these funds.
Yeah, I think it'd be, good to have that discussion when we talked with the legislature about spending policy, if we knew a break-even point in that regard and know what we'd have to do. At least we'd know where we'd break even at. And I think that's a good discussion that you have in retirement systems, because they have the actuarial discussion and bring all those different factors in there about, what kind of return you're going to have to keep it at 100 or move toward it.
Mr. Chairman and Treasurer, to your point, I think your 4.75 is probably a pretty reasonable estimate. Just looking at these numbers here, you can see 4% real. We've got actually a 58% probability. So it's somewhere between those two, probably closer to the 5 than the 4.
And Mr. Treasurer, you and I have augured for that 4% for a long, long time. And it used to be 8% back in 2002.
Yes, I remember.
Yeah. Yeah. One question that I have, Josh, just to sort of, and I don't mean to sound stupid about this, but dividends, interest, rents, do those grow your fund?
Mr. Chairman, it depends on what you do with them.
Yeah.
If you spend them, no, they don't.
Okay. How about capital gains? Is a capital gain a way that you can say, my fund has grown?
Well, again, Mr. Chairman, it depends on what you do with it. If you reinvest it, yeah. If you spend it, no.
Well, but your capital gain means that has gained. The capital, your investment in that fund has grown.
Yes.
Is that not correct?
That's correct.
Yeah. So that's my point.
Yeah.
My worry is that everybody looks at this as income.
Yeah.
But if you use an analogy of a house and your house appreciates, and so you're going to keep the house appreciation value at the same, you sell the room off or you sell the garage off. It's, and then if the value, if it devalues, you just have less of less.
That's correct, Mr. Chairman. Yep.
Okay.
Yeah.
Mr. Chairman, just one quick point. Legislature, specifically Representative Harshman, has done a study on looking at the mineral income, as Josh alluded to, the growing of the funds that has covered cost of inflation. Obviously, the inflation rate over the last 10 years has been somewhat benign historically. So whether or not you still will have the mineral income to do that, but part of this is looking at the portfolio income as opposed to additional income that we do have coming in. Whether or not that grows or not is who knows. And just one other point, when you talked about the growth of the PMTF and being able to do this, the big point that I want to talk about is when we look at endowments. We've mentioned this before, but we can't compare ourselves to an endowment because our fund's in a violet. Endowment funds spend principal. They get a significant amount of income coming in as well. So it's not, we're trying to become more endowment-esque, but as long as we have this problem or issue where we don't look at all of our income, we will not be able to be compared in that area because we cannot spend principal.
And Patrick, it's a great point. And most universities have great endowments, they do particularly well. Some universities have done very poorly by their endowments and are now no longer universities. So it's no guarantee that if you put an endowment model in place, the world is going to be right side up. I want to make that point. One, and then the second thing, go ahead. I know you want to.
Well, Mr. Chairman, great point. Follow up on the presentation that I gave at the Milk, and I pointed this out, that this happens over and over and over again as everyone moved into these illiquid securities. What would you say the average in the Ivy League endowments when they had to sell these privates in the secondary market because they didn't have the money? How many cents on the dollar did they send it on? Wood nickel to the winner.
Yeah.
51. 51% cents on the dollar. So they lost 50% of their investment because they're reaching for yield and they don't have the liquidity to support it. Yes, they're not inviolate, but when they sell, they're selling at a discount. Did you say 51?
Well, you had information before. So the other question, and I appreciate Representative Harshman. He's a very smart man and so on. But what I would also point out is that the way the Permanent Mineral Trust Fund got established was with mineral income. And so to say that we're inflation proofing the investment returns probably is correct, but if that's the correct interpretation of how those dollars should be used in the Permanent Mineral Trust Fund, I'm going to say that is incorrect. Okay.
Mr. Chairman?
Yes.
Thank you, Mr. Chairman. Just a quick question to flag that I think probably will be better in that discussion about reducing our exposure to China, which I absolutely agree with. But looking at, our international equity being overweighted, if in that discussion we can talk to about more broadly other countries as well, just knowing that there is other political turmoil and risk and other countries that have that contrary climate policy. And so I don't know, now's maybe not the most appropriate time, but just wanted that to be part of the discussion as well. Thank you.
Just real quick, Mr. Chairman, Superintendent, yes. So that international equity, that -2% portion is because we have seen this move in international. And so even though it's cheap, yes, we're looking at it on an ongoing basis and how does it look on a forward basis. There's other opportunity sets that we feel in the equity-esque sector that will outperform. So that's why we're pulling that down. The equity, the Chinese equity is a different situation, which we'll discuss.
So Josh, I'm sorry to take us on all these little rabbit trails, but they have been helpful. Please get back to that.
They have indeed. Thank you, Mr. Chairman. And for the record, we're not recommending any allocation to wood and nickels this year. Not yet. Page 4, and I can wrap up here, I think, pretty quickly with some of the rest of the recommendations. Workers' compensation, one of the recommendations that you see here this year that's a bit of a theme is this concept of simplifying the portfolio structure. I think many of you have heard Patrick talk about how complex the structure is. You've got lots of different portfolios with slightly different allocations. And we do see some opportunities to simplify and consolidate the portfolio structures a bit here. And one of those is with workers' compensation. And the concept of two portfolios within the workers' compensation fund is one that you've embraced for several years now, with the fund being pretty well funded. You've got you've got enough assets to cover what your actuary projects for your liabilities with a pretty healthy surplus on top of that. And so what you've done is you've taken the actuary's estimate of those future liabilities, and you've set up a part of the portfolio that is just asset liability matching. So it's a fixed income portfolio that has the same estimated interest rate characteristics as the liabilities, so that regardless of what happens with interest rates, that part of your portfolio is going to move. If you think about the workers' comp balance sheet, you've got liabilities, you've got assets, they're going to move together in the same magnitude and in the same direction. So you've kind of got that locked up, not perfectly, but pretty tightly. And then as it relates to the excess, and you do need excess in a workers' compensation fund because this is not as precise as a pension fund is. With a pension fund, you've got a lot more precision as to what the population is, what their retirement benefit's going to be, how long they're going to live when you're talking about large numbers. The variability and the uncertainty in these projections is a lot wider for a workers' compensation fund. So you do need some excess for adverse outcomes. But the recommendation here is to actually consolidate that excess reserve portfolio and invest it exactly in the same manner that we just described for the other permanent funds. So that would be the recommendation there.
Josh, just a comment on that. Obviously, the actuarial studies that we started looking at worker compensation potential liabilities have helped. But I do believe that there will be probably in legislative session a couple of attempts to modify what workers' compensation requirements for employers might be, and that might put an additional draw on that. So in looking at this, I think we want to make sure we keep a portion of that excess reserve relatively liquid if the legislature chooses to make some changes, if that makes sense.
Absolutely. Okay. State agency pool. The recommendation, and this is not an asset allocation recommendation because state agency pool is and should remain high quality short-term fixed income. This is a pool that's used by many state agencies as a source of liquidity. But we will have some policy recommendations for this. Currently, this fund only invests in treasuries and it owns those treasuries to maturity. That's worked reasonably well, but we do see some opportunities to add in and allow the team to take a little bit of credit risk, high quality, short-term credit risk where you've had historically extremely low experience of default. If that's done in a diversified, highly diversified fashion, that's sort of an easy one these days to add some incremental return to the state agency pool. But those will be investment policy recommendations that we will put before you at your June meeting. For the reserve funds, those are currently, the reserve funds for the permanent funds are currently invested in the state agency pool, but they will be growing based on the legislation that was passed this year. And so we will have some work to do. And there's no recommendation for this year, but we anticipate this being part of next year's process to establish a liquid reserve for the permanent funds. As those funds are larger, they can and should be invested in a higher return seeking fashion with more return-seeking assets, higher returns, because if you have larger reserves, you don't want them to be so conservatively invested that they just drag down the total return experience. But because they are needed potentially as reserves to fund your distributions, they will need to stay more liquid. Pool A, we had no changes to the recommendations for Pool A this year. Other than the one small adjustment was you heard Seth from the equity team talk about the movement out of preferred securities. And as those will be going out of the portfolio on the common school side, they've largely been there for their income characteristics. They would also be removed from Pool A and simply replaced with high quality, short duration fixed income. And then lastly, on the LISRA front, no changes recommended for this year, although we did discuss at the IFC meeting, there does appear to be potentially next year some opportunity for streamlining this portfolio. Currently, it's subdivided into 3 tranches, a short-term reserve, an intermediate-term reserve, and a long-term reserve. But if you actually look at the second and the third, the intermediate and the long-term, and you put those together, they look a lot like what we're contemplating for the permanent fund liquid reserves. So we anticipate there might be some very logical opportunities to streamline that as we get into this next year.
Josh, just a quick question on that, and Patrick, maybe do we have private equity in that? Or any long-term?
Mr. Chairman, no.
Long duration? No. So when I was thinking about that 3-tiered deal, it was with the idea that that third tranche could be invested extremely long duration, which would mean that if you had to invade it, you could take the 51% loss. I understand that. But from a point of view of total return, it would obviously seek more. That was my thinking on that. I do understand that, we need to have some more discipline around how we use the LISRA. And maybe we can only achieve a 2-tier approach there.
Just clarification, Mr. Chairman, when you said long duration fixed income versus long duration
No, I
equities.
meant
Okay.
long-term
Okay.
investment, yeah. Thanks. Mr. Secretary.
Thank you, Mr. Chairman. I want to understand a little more about how the LISRA is invested, which has always been a little cryptic to me, even in the legislature. What does that look like on the ground right now in the three tiers? I mean, especially the intermediate and the long term. How is that being invested right now? What have the returns been in the LISRA?
Mr. Chairman, Secretary Gray, if you go to page 41, this is an outline of how that's invested currently. And the policy establishes these three tiers, but it does not drive how much is in each tier. That should be a treasury management exercise, as any company would look at its projections for cash flows and decide how much they need in liquid versus longer term assets. But the tiering starts at the bottom, the short-term reserve, which I do believe statutes require this to be, is it at least 500 million?
500 million.
In the short-term reserve. I believe it's larger than that today. But that's 100% low duration, high quality, short-term fixed income. So very safe, very liquid. Intermediate is still 100% fixed income, but it's taking a little bit more interest rate risk. This is more of an intermediate portfolio. And then you can see the long-term reserve is invested exclusively in return or seeking or diversifying assets, so broadly diversified across equities, MLPs, hedge funds, and bank loans. I apologize, I don't have in front of me today the current market values. I think looks like Patrick does. So yeah, we can answer how it's divided amongst those three as well as the returns, which you asked about.
Mr. Secretary, probably when you entered the legislature, this was mostly just fixed income. And it just was a large fund growing larger.
So Secretary Gray, over the past 3 years, let's talk about the last 3 years. So that's about the time period that this three-tiered structure has been in place. The total LISRA has had a 1.8% return. But if you look beneath the hood, the long-term LISRA has had a 9% return. The intermediate has had a minus 3.6% return, and the short-term reserve has been basically flat. So the bond pieces have actually been hit so hard by the rising interest rates in the last year that those returns are actually now negative. And the part that doesn't own bonds, that owns these diversifying assets, has actually done extremely well, 9% over the last 3 years.
And part of just a little bit of history, Oklahoma has a similar fund, constitutionally protected. You can only use 1/3 of that fund in a year. You can use the next third in an extraordinary circumstance. They've defined that. And then the long term is to be used over 2 years if you have losses. We did not have those constraints on the LISRA, as you well know. And so my hope was that by starting to segregate this, we would bring some discipline to how we spend our money out of the LISRA. But I honestly, I think you're going to 2 is probably easier and more effective. I don't think we give up that much in return on a normal horizon, so. I don't know, Mr. Treasurer, if you have any thoughts on that.
No, that's a structure I think that offers more flexibility, and especially we are kind of locked into that intermediate bond fund by that intermediate time schedule, which essentially generated the losses, where if you have a flexible two-tier structure, then you're not locked into assets that necessarily you don't want to buy.
Mr. Chairman, on page 5, and this is the last page I'll plan to present, but happy to answer any other questions you may have on this asset allocation recommendation. This is a bit of our attempt to capture the discussion that took place at the IFC meeting in terms of what this overall structure could look like in terms of the simplification and streamlining of this as we move forward. The top half, where it says 2023, this is in essence what is being recommended to you today, where you see each of the funds across the top, and we list PMTF and Common School Permanent Land Fund. Those are intended to represent the other permanent funds as well that invest under the same policy today. So you've got those two categories of permanent funds, workers' comp, LISRA, and as well as other state agencies that participate in some of these investment pools. And then on the left, you have portfolios. And so you can see portfolios range from the long-term total endowment portfolio. That's not a name that's actually in your policy anywhere currently, but it's how we're describing this new consolidated single endowment portfolio. You've got Pool A, SAP, the liability hedging portfolio for workers' comp, and then the 3 tiers for LISRA below that. And then there's an X for each of the funds for the pool that it has ownership in. So the permanent mineral owns 2 things currently, the long-term portfolio, and then its reserves are invested in the SAP. The column, the bottom half of the page is just a little bit of a vision for what this could look like potentially in next year's process. And that is as those reserves grow for the permanent funds, not being invested in SAP, but in being invested in a higher returning but liquid reserve portfolio, which could actually be potentially consolidated with Pool A. That was something that probably need to be studied a little bit more for feasibility, but that's a possibility. The workers' compensation fund, that would not change, but you can see that LISRA would be, could participate in that fund as well as it would still need its own short duration fund. And then the other state agencies, as they can currently, essentially have a choice between the short-term SAP or the longer-term Pool A structure. And with that, Mr. Chairman, I'll stop and happy to address any additional questions the board has.
Questions? Mr. President, good to see you. I should have recognized you sooner, so my apologies. So, questions? Questions? I think you've done a great job. Thank you.
Thank you.
Do you want to go just very quickly? I think you've got a chart here on basically what portfolio risk looks like with taking a higher level of risk, just so you can sort of explain where the efficient frontier lies.
Portfolio risk, Mr. Chairman, for the permanent funds?
Let's talk about the permanent fund.
Okay. Well, I think the best page for risk is back on page 24.
Okay.
Where we do the Monte Carlo simulations that I noted. The recommended target 1 year first percentile drawdown is about 19%. So, you know,
what I was thinking about was when you talked about the different mixes on your.
Oh, sure, yeah. If you go back to page 23.
Yeah.
That's actually got all of the detail from the efficient frontier. Those are portfolios 1 through 10. So those are the actual portfolios on that green line that I described. You've got the recommended target there. One additional portfolio that you see here, the current combined permanent funds, that's actually how you're positioned today. If you were to take all of the permanent funds and just put them together into one portfolio, you're not actually going to be able to do that necessarily, primarily because of the private markets. I think there's some significant logistical hurdles to taking the private equity exposure that's owned by certain permanent funds but not others and transferring that. So we will have to start building the income-focused funds Common School will have to start building out their private equity portfolio as a standalone sleeve. Was there a specific question on risk?
Well,
Mr.
I just
Chairman, that
wanted
had?
you to walk through where you came to the allocations that you recommended.
Yeah, so if you go back to page 22, actually, I think graphically you can see where that portfolio is. It's right between portfolios 8 and 9 on the frontier.
But each of these represents a blend from the more conservative to the more risky.
Absolutely.
And that's what's on the second page. Maybe you've gone through all this, so.
Mr. Chairman, I think it's would be good to realize that a lot of times we're compared and contrasted to WRS. Their risk this year, I think, came in at 14.28 on their standard deviation.
Yeah.
In their asset allocation. So we're well below that. I think their arithmetic return was 8.39 or something, but and but that's you're taking in a lot more risk, doing a lot of different things. So I just wanted to make sure that when we get compared to them, that risk aspect is in there too. And I'm not suggesting that we need to go out to 14% here, but they've got a big hole to fill.
Right.
What do you think about these numbers? The recommended target, for example, has an expected average return of 7.5, and expected risk, which is standard deviation, which is a statistical measure of the volatility of those returns, of 11.5. And in a simple view of risk, you can translate that into, in any 1 year, you'd expect the returns to be 7.5 plus or minus 11.5. And that would get you 2/3 of the time. That's the range you should expect. And then to get 95%, you do that again. And that gets you out to, essentially 7.5 plus or minus 23. Now, my earlier comment was that that's too simple. The world doesn't really look like that. There's not this equal distribution of good and bad outcomes. What we find for equities especially is that the central tendency, the middle of the curve, actually tends to be a little bit higher, but the tails of sort of more extreme outcomes on the downside are more probable than that would suggest. That's where the Monte Carlo simulation that we outlined on page 424, we think does a much better job of getting a more realistic view of what downside risk could look like. And that's the 1 year, about a 19% loss on this portfolio.
Right. Well, and my point there is when somebody says, well, we should have 6% return or 7% return, that goes with the risk. And the risk, as you point out, and I think we looked at this at one point too, is if you have real capital losses in your portfolio, it doesn't recover in a year's time. It takes several years to recover. So the risk portion of this is something that should be taken very seriously.
Yeah, like if you lose 50%, you need 100% return to get back to even. Exactly.
Right.
Yeah, and Mr. Chairman, just to completely agree, and that's why we do this stress testing. One of the lessons we learned from the great financial crisis was we never want our clients to be surprised by what happens in a bad year, because bad years will happen, and critical to long-term success will be the ability of the client boards we work with to stick with the long-term strategy. And that requires understanding what downside risk could look like. So, thank you.
Yeah.
Mr. Chairman, is now a good time to address the liquidity issue that you and I talked about? So this is more of a last minute, and just so for the audience knows, this is not the first time all of the board members have heard this. We've met with all of them individually, gone over this, so it's not like we're making billion-dollar decisions in an hour or 4 hours or whatever. This is a well thought out, long-term process of what we do. But in the discussions, the governor made a mention of some of the liquidity issues, and because liquidity is such an important issue, I just wanted to address the liquidity concerns that we have. So as you can see on the chart there, what Josh has pointed out, underneath all of the different sectors, you see the total illiquid assets. So in this, the target, recommended target, so 42% here is the illiquid assets. So by definition, 58 is liquid. But the big concern that we have is that I don't really care about the liquid assets. I want to know what the liquid assets are that are not highly correlated to equities. Because the time that you typically need liquidity to go into these things is when the market is under stress. And I'm not saying anything with RBK because Josh and I, we've talked about this in depth, but the governor had asked to quantify the number. And so that's what Josh had done and put together this chart. So when you need the liquidity, I don't want to sell my equities when they're down 50% to get the liquidity. I don't want to have to hit, these ridiculous bids in private equity and these other privates at 51 cents on the dollar to get the liquidity. So what we did here is just to highlight the difference, and this is all on the correlation charts that you see here, but just looking at where is our liquidity and what the correlation would be. So if I can highlight here and kind of show you what we're looking at, is the two different components that we're looking at is it liquid, yes or no? And then correlation to US equity markets. And so the
high, medium, or low.
Definition of high, medium, and low was?
High is greater than 0.7 correlation. Medium is 0.5 to 0.7, and low is less than a half, 0.5.
So as we all know, fixed income markets are one of the lowest correlated assets, and sometimes negatively correlated, what have you. But when equity markets go down, they typically will go up. And that was one of the reasons when we shifted out of it, when rates are extremely low, that insurance policy, if you will, was gone. Because what were 10s going to do? 10s were going to go from 80 basis points to 0.
Yeah.
Big deal. That didn't offer us the cushion. Now, where we are with 10s at 340 or what have you, you actually get a cushion. 2 years, at 4%, you get that cushion if things come down. But just to understand what we're looking at here, what is liquid? Yes, but low correlation to U.S. equities. And so as you can see in this U.S. fixed income, that 10%, that is a big cushion for us. For instance, Yale, last I saw, what was Yale's fixed income? Like 3% or something, 2%? They don't have that. So that's something that we're very cognizant about, having that liquidity to be able to work through this. And the other part is what we've done internally to try and mitigate this as well. So for instance, if you look at hedge funds, which is the bottom one, are they liquid? No. Well, to a certain extent, depending upon the structure that you've done, and correlation to the equities medium. So in this instance where we feel that equities are, slightly overvalued or what have you, everything that we've been talking about, we've been moving over the last couple of years to higher quality assets. You don't want to be in single Bs when a recession hits. So for instance, in hedge funds, what I've been doing is moving to more liquid. We're trying to get more liquidity. We've been liquidating some of these funds, but we reduced the beta exposure. So a lot of the funds that we had previously had a higher beta to the market, and now we're moving to a low beta, a lot of market neutral, low beta type of funds, more credit sensitive type funds, or definitely private credit. I'm meeting with them next week to go over more of these funds. But just for instance, that's what we're trying to do internally that wouldn't necessarily show on this chart about what we're trying to do in liquidity. So just an overview in this scenario, if things go pear-shaped, you need liquidity. This would be certainly imperative that we have liquidity. And this is something, just so you know, that we're looking at and want to make sure that we have it. Governor, did that kind of quantify some of the numbers when we were talking about this? Is this
Yeah, that.
sufficient for what
that
you're looking at?
helps. Thank you. Thank you very much.
Mr. Chairman.
Yeah, Mr. Secretary.
Yep. You know, I maybe probably should have asked this when we had the equity guru up. But, you know, I'm a little troubled by, you know, you got US equity, the allocation there, and the non-US equity. I mean, it's a pretty broad, broad classification. And, you know, on this China discussion, you know, I'm very opposed to us investing there for a variety of reasons. What is the allocation with a non-US equity? I mean, it's, you know, where is that going? And why, you know, we're taking domestic and just having an allocation for that, and we say international, and the allocation is 40% higher, and there's really no description on where this is going, what indexes, where we're focusing on that geographically.
So Mr. Chairman, Mr. Secretary, if you look at that recommended target, you see those percentages. So right now, as you can see, broad US and small cap is 12, where international is 16. So we have 4% overweight, or additional weight, a higher weight to international. And part of that is from the valuation. International has just been crushed. Valuation wise, we're 20 PE on trailing 12 months, 18 on a forward. As I mentioned before, 68 percentile valuation. US equity is fairly fully priced if in fact we're going into a recession. So in that instance, we have kind of gone into a lower risk asset. Now, with what's happening in some of these other opportunities, we are reducing that exposure. So you can see we're going -2% in that. So just so you understand what the definition of is, so we have two different asset classes. We're going to go into this in the China discussion, but we have US, which is our broad US, S&P 500, small cap, Russell 2000, and we have international. What's international? International, our index is the ACWI-X, All Country World Index, ex-US. So if you look at the breakdown on that, why are we taking ex-US? Because we already have the exposure. So the difference of it would be your EFA, your Europe, Asia, Far East, what have you, and then you have 28% in emerging markets. And of that emerging market, you would have approximately 9% in China. So that's the breakdown of the international. That's the definition of it. Does that help?
Yeah, Mr. Chairman, Mr. Fleming, where is that 28%, that allocation within international? Where is that listed?
The actual country investments?
The geographic spread, you could call it, or?
Mr. Chairman, Secretary Gray, there's a couple places. As a board, you set the guidelines for that in investment policy. So the benchmark that you establish in policy is the one that Mr. Fleming referenced. And then the actual monitoring that provides the detail of that is in our quarterly performance reports. We don't have that in today's materials, but that is a routine report that we provide.
I could tell you right now where it is on the top 15 countries anyway, in emerging markets. So of that 28%, 31% is China. Of that 20%, or the total index would be 9, but of the EM, which you ask, it's 31. Taiwan is 14.6, India 13.7, South Korea 12, Brazil 5, Saudi 4, South Africa 3, Mexico 2.8, Thailand 2, Indonesia 2, Malaysia 1, UAE 1, Kuwait, Qatar, Poland less than 2%.
Mr. Chairman, Secretary Gray, just one thing to add to that. There's also an important distinction between passive and active management here. If you have passive management, you just own what he just said. You just own the index and you own it because it's in the index. Your active managers, and you have both active and passive, your active managers have an opportunity to make a decision, and they may or may not allocate according to that, but their performance will be measured against the benchmark.
Mr. Chairman, what's the European spread? And what's the European allocation?
We'll see
Of the international.
So then your European components would all be Germany, France, all the developed markets. So they would be the remaining part of that EFA, except Canada, which we then back them back into it. So that would be all of the other developed markets, which would be England, France, Germany, all of the large Canada, the developed markets of the world.
Okay. Mr.
Sweden,
Chairman, is
Finland,
is Southern Mediterranean not in that?
Greece, is Italy, Southern Mediterranean in your definition?
Yes.
Yeah, so Italy would definitely be included in that component, and I can get those weights for you.
Okay.
Mr. Chairman.
Of the total, correct?
That's correct.
Yes.
Right. And I think the point Josh made about some passive, some active is very clear. The passive just does the index, and that's going to be represented across that.
And one thing to know, Mr. Chairman, on the index as it relates to China is the index providers have been incrementally adding in the China A shares, which are the local market shares that have previously been unavailable to foreign investors. And the index, I believe, is currently only including 20% of those. But if it was at full inclusion in the index, instead of 31%, China would be something closer to 42% of the index.
And that was always my problem with China in the MD, is it just swamped everything. But
a lot of investors are having this discussion of, do we want to own it just because it's such a large part of the index? Do we want to take that weight? And obviously with, the concerns around geopolitics, as well as the, how you've seen the view of capital and how that's treated, is raising some significant questions.
Right. Okay.
Mr. Chairman, the next topic that we have on the agenda, if we're finished there, would be the state agency pool, followed by the China discussion. Since we're already on China, would you care to switch that and just continue with our recommendation?
Sure. What's the pleasure of the board? Everybody cozy? So if this is a good pause, why don't we just take a 5-minute break? Thank you. forum, and I think we're ready to go. Patrick, we were about to delve into China.
Yes, Mr. Chairman. So this is something that we were not able to discuss at the IFC, or we didn't, just because some things that have been happening. We've talked about it, about China exposure. And actually, the last time the IFC addressed it was with their kind of fingers throughout all kinds of different manufacturing throughout the world, second largest economy. Should we have a dedicated Chinese exposure? Because our exposure is primarily in equities, which is slightly over 1% of our portfolio. And we're way too low if we feel that this is a next big thing. And in fact, if you remember, our first foray into the area was that SC Capital on the real estate side, because we said we don't want to take direct Chinese exposure, but we want to take the peripheral just because Southeast Asia is a growth center. And that continues on to our belief here. But things have changed. Just since the IFC meeting, we've already seen conversations with Putin and what they're trying to do internally. We're talking about currency components, which I think I'm going to comment a little bit on in our gold discussion. They just instituted a restriction to have domestic companies send information on Chinese companies abroad. If you're in China, it's okay, but you cannot send it abroad. So how are our investors going to be properly able to ascertain the Chinese risk exposure? So these numerous things happened. And so anyway, I said, we have to have this conversation. So the IFC has not opined on this yet, but I think it's an extremely important decision. So this has nothing to do with China, but you have mandated the investment team to have the highest risk adjusted exposure. And if we cannot ascertain the risk with a country where we do not have a good rule of law, we have the opacity of the very opaque investments, and we have a leader who will just come in and has said, no, education, you can't make the profit. Tech, you can't make the profit. We've seen these tycoons have disappeared, and all of a sudden they come back after being away and have retired or have made numerous multi-millions / billion investments into the public sector. So these are the things that, is this really capitalism, or is it socialism, or what is it? And Xi has already commented that he doesn't believe in capitalism. But in that instance, it makes me very nervous when I cannot fulfill the prime objective.
Yeah.
And so we have some suggestions that we would like to present to the board or the IFC or whatever your wish will be.
And just a question, they were trying to merge Shanghai and Hong Kong. Tom's comment was kind of interesting. Hong Kong has not been merged, but now you're also seeing A shares coming into the ACWI US. Where are the B shares in that? And I'm just curious about that whole mix. Is there a differentiation now between Shanghai and Hong Kong?
Well, Mr. Chairman, so my understanding the MSCI is we have 20% in A, and they're going to be increasing that exposure. And as Josh mentioned, it's going to increase. But the B shares are the offshore foreign currency denominated shares or what have you. But Josh is the expert on the MSCI. And by the way, I spoke to the head of the person who is appointed by MSCI to represent the funds. And I said, is there any discussion that you'd have to potentially limit China from these indices because of their policies? And his personal view was absolutely not, because of the structure and the fees and everything else MSCI receives from the people who invest with these indices. So we're not going to, highly unlikely that we'll get relief from the index saying, no, this is not, there's too much risk from the capitalist side. That's not going to happen. So Josh, do you want to comment on the index with the A's and the B's? Is there any other?
Mr. Chairman, the biggest allocation is the H shares. Those are the Hong Kong traded shares. and Seth or Fung may actually know better than I do the exact mix of those today, but I want to say, and I'd ask them to correct me if I'm wrong, but thank you, Seth.
Far right.
Yeah. So of the 9% that China represents in your policy benchmark, 2.27% is H shares, so those are the Hong Kong shares. 2.5% are ADRs, so those are American depository receipts. Those are Chinese companies who have shares that trade on a US exchange. And the A shares are currently 1%.
Okay.
So, Mr. Chairman, as far as exposure, in the group that I'm with of that 28 trillion or whatever, they did a survey just to find out how much exposure was there, and the average is 8.5% exposure to China, both in private and public, and a majority of the larger exposures would be in the private sector, that they're locked in for quite a while. So with that, our view is that we don't really, 2 years ago, we wanted to increase or looking to increase the exposure, but what's happened there, I think, has been a dramatic turn. So what we are proposing is not to be completely out of it because we don't really know, but to take that index portion. So right now, looking at our $3-odd billion investment in international, and as I mentioned before, that's the IFA, emerging markets, and China. So 9% exposure, which, we're talking about 300 million, is take the index portion and strip that out. So we would have two indices. We'd have the ACWI-X, which we have right now, and we'd have ACWI-XX, if you will, for a better name, ex-US and ex-China. So our index managers would not, because they just invest what's in the index. So we'd strip that out and not have them invest in China. So that would be the ACWI-XX. So we don't have that exposure. But there's tremendous opportunity with our active management. So they can see things where they will invest in companies that have a lot of exposure in China or whatever, but they have exposure elsewhere. So we want to be able to have that flexibility to be able to do that. And so we'd leave this up to Josh and the board to come up with a good index, but just keep it simple, stupid. What if we had 50% in ACWI-X and 50% in ACWI-XX? And then that would give us flexibility similar to what we do in the ag between treasuries, governments, U.S. governments, treasuries, and mortgage backs to go between the two. So what we're proposing, or at least we'd want to put up for discussion, is we'd take the index managers, and so they wouldn't be forced to invest in China, and so we'd have them focus on the ACWI-X, X, and then we would leave the same for our active managers to be able to still invest if they wanted to, and do both sides. That would be the baby step to see where we are. And at a later stage, if we felt like we had to move it all the way to a ACWI-XX, we could do that. And that's what our proposal would be, or at least first point of discussion.
Madam
Mr. Chairman.
Superintendent.
Thank you, Mr. Chairman. So that 50% that would be in the ACWI-X, full stop, would be actively managed.
Correct.
Okay, thank you.
And so they could decide, yes, it's too much risk here. We don't want to be in this. Yes, there's not. But as far as our ability to produce income, it gives them tremendous amount of flexibility and would hopefully offset, any risk that we would see if Xi decides to change something else.
So, Mr. Treasurer.
Yeah, and Patrick, what I guess this kind of dovetails to the superintendent's question as well. The active management on essentially an index, because you have an ACWI-X actively managed, but the actively managed part, is that limited just China, or is it just wherever they want to go? And why is it still an index, and are we still graded on the index then?
Mr. Chairman, Mr. Treasurer, yes. So whenever our managers, when we tell our managers the index that they're managing on, all of them will look at tracking error and basis risk. And that's how we and managers produce alpha. So they'll look at it and say, well, whether we want to be in China, out of China, overweight Korea, overweight whatever, they need that index, and we're already contractually obligated to our outside managers to have that index.
So essentially, we're going from 9% to 4.5% in China?
Mr. Chairman, that would be correct if, in fact, the active component would choose to do so.
Okay.
But that gives them the flexibility of going from 0 to 10 or whatever. They could go either way. But the problem that we see is I don't want to be indexed to, we know the indexers are going to just take that weight, that market weight, that 9%. They're going to be in there. And that's what we're trying to exclude. So we don't want to give up opportunities to make money, but I don't want to just be blindly in something because it's in the index.
Mr. Secretary, give me 1 second. Mr. Treasurer, I think this is an interesting proposition. I was just wondering, are you going to have an opportunity to work with the IFC on some of this? Because I do think about the index tracking, and, there are features.
Yeah, I think we have to
Compensation on that.
drill down on it, see how it works on, our performance package, and see how, I think that we may end up with a custom type of an index that we're graded on as far as performance, because we're obviously are going to have tracking error.
Right, and
So-
that's the
so-
reason why I was thinking it might be useful to have
Yeah.
them.
Yeah, so I think it
opine
all
on it.
interrelates into that as far as the performance pay, the tracking error, the flexibility, and, good discussions with who the index manager is to see what their thoughts are in this particular thing about how their philosophy is, I guess, basically on China going in and have drill down and find out what we do this, what is the end result of what we can actually expect.
Right.
From my perspective, I think that China is almost uninvestable to the extent that Patrick mentioned the problems that they have there at this point in time, and that I'd almost look at from, I guess, if India's the place of the day, maybe we need to look at some way where we're overweighting India if we're underweight China. Maybe we overweight India when we in the XX or something, Yeah.
Well, and I think you'll have time to deal with that, but thanks, Mr. Secretary.
Mr. Chairman, one of the first bills I ran in the legislature in 2017 was a bill to say that we wouldn't invest at all in any entity that interacted with Cuba, and it was Iran. And it went down in flames. House Revenue Committee back in 2017. I think you testified on it, now that I think about it, against it. But anyway, I don't understand why we need to be in this at all. I mean, to me, it's a very basic question, which is, can we achieve a diversified portfolio without investing in this sort of thing? And the answer, I think, is a very clear yes. There are more than enough investments. There's enough geographic distribution with international equities where you can achieve a diversified portfolio. And at that point, to me, there is no sense in investing in an area that wants to undermine our security and doesn't like us, not to mention the fact, I mean, you focused on the reporting aspect and potential problems there. I mean, but there's also just the overall, situation, and it doesn't make sense for us to be doing that, in my opinion. So I guess it leads to a question: can you achieve a diversified portfolio without doing this? And to me, the answer is clearly yes.
Mr. Chairman, Secretary, that's a great point. And I really try to be what my personal views are and be agnostic to that point. And what I am looking at is purely the return to the state. And the one part that we have to, everyone fully realizes is you're talking about second largest economy in the world. And so if you're saying that you're excluding opportunities in that type of growth and that type of size is problematic. And so in the past, because we've been reluctant, as I said, the 8.5% is the average. All of the other funds have significant exposure. We are de minimis compared to everyone else. And we said, okay, well, we don't feel comfortable there, but we want to participate in that growth. And so we've done in some of the peripheral. And I have those numbers that if we excluded them, India would go from 14 to 20%. So we know what that would do. And so in that instance, I would say, yes, we could still exclude China and get some of those benefits by the countries they're doing business with. But by completely excluding all Chinese investment, there's potentially a degradation to our total returns.
And I would, there's also risk that could compound by overweighting other countries significantly. There are a number, I mean, you'd have to look at what the mix of investments would be. And I appreciate that, but I think having in my time been here, we've had, let's not invest in Iran, let's not invest in anybody that does anything with, if that has anything to do with boycotting Israel. These are all good things, by the way. Let's not invest in anybody that does anything about firearms. Let's only invest in tobacco products. At some point you narrow your universe so much, and that's all to the benefit of those that put that forward, not necessarily the benefit of the people of Wyoming. That's my biggest concern when we start trying to target for any particular social or environmental end. We do that on the backs of Wyoming taxpayers.
Yeah, Mr. Chairman, I guess, Patrick, the question I have is that rather than having an index fund do that, are there any, China-only investment firms out there that if you really wanted to get an active manager in China, that you would go to an expert firm, and if you wanted 100 million in China rather than 300 million, you'd give an expert firm 100 million and do everything XX.
Mr. Chairman, Mr. Treasurer, absolutely. And there's nothing, as we know, we're not voting on anything here, but this is something for discussion. And your comment on the IFC, we've talked about having more of a group think, and I don't know if time-wise, if time would permit, but having their opinions on it, live, and you could hear from the horse's mouth their opinions. But, these are the things that we would hope to bring.
Yeah, we have Tom.
These are the things that we would hope to bring to you in June, because I do believe that every single person that I talked to at Milken this last 3-4 days, I specifically went up to them, what are you doing with China? And every single one of them is looking at talking about it or potentially doing something. And I don't want to be the last one out. I want to be the first one out. So I do think there's a time sensitivity on this, and I think we're fine in June. But that is why I wanted to bring this up without having an IFC discussion to come with you and say, the IFC recommends X.
And so we have Tom and we have Russell, and the other thing is when everybody's running to the door, like you said, last one out, there's a big challenge there too. So Tom, and then I'll see Russell.
Sure. Thank you, Mr. Chair. I mean, I completely agree with Patrick's point, sort of with China on the sort of the short term. I mean, there's no question that this is a very different China than the investment opportunities we saw between 2008 and 2014. The only thing I would really caution, because when we think about this, again, with the permanent nature of our funds and really looking long term, of necessarily excluding the second largest economy, as Patrick just said. So I do think that we need to be very careful with the way we think about China. And I guess, Patrick, because, you know, and this is sort of the first that we've heard of this, the IFC, and I do recommend that we maybe huddle a bit to discuss this in terms of how do we do it, because I do worry that there's a difference of sort of a market tactical position about, let's say, underweighting it versus a longer term position strategically of how we do this. And, you know, Patrick, you know my views on, you know, don't be afraid of tracking error, et cetera. But I am a little concerned with sort of the direction that we're talking about. And then overall, Mr. Chair, you know, 4% GDP growth that China just had is not going to do it. And so they're going to do everything in their power to try to grow this economy. And I guess the comment about being the last one out in terms of the investments, I completely understand that. But at the same time, to me, when I hear about the negativity about people or concern about people investing in China, to me, I feel like from a long-term standpoint, that could actually be a reasonable opportunity. So, but at the end of the day, I do think that we need to be extremely careful on the political nature about the way we look at different investments, because at the end of the day, we've got to think about what are the best benefits for the citizens of Wyoming. And to try to alienate necessarily the second largest economy, I don't know necessarily that's the best thing. So thanks.
Okay, Russell, then I have Doug, then I have Ken. Russell.
So I think there has been a change in the views of a number of international plans, which I think are important for our consideration. So a number of the Australian plans up until the last few years, they actually, a number of the Australian plans have said, like the Australian Future Fund, they said, we don't like the emerging markets, but we do like China. And that they had that. So for them, China was their proxy for the emerging markets. This has changed, I think, fairly dramatically. And there's a counterbalance to China, which is it's more than India. It's sort of this. It's the whole economic zone that is interrelated from Southern Asia, Middle East, including, frankly, Africa. Which is a counterpoint. It's and which represents, you know, a good portion of the world's population, but more importantly, a good portion of its growth. I agree with Tom that there's sort of, when looking at the emerging markets, there you could sort of segment it into, for good reasons, by the way, into this China, what we call the Miaza region, Middle East, Africa, Southern Asia, and Latin America, and they're quite different. The Miaza region is the only region of the world which is actually growing in population, and the rest of the world in general is not growing. That's sort of a big factor, has its own dynamics. So, but my agreement is that these are this part of the world. You didn't, if you went back before the year 2000, you could just have avoided the emerging markets completely. It was a distraction. It was a lot of risk and not a lot of, you know, growth and return. Today, it's different. There is a big slug of the world's growth and the increase in its growth, which is in the emerging markets. So it's, I think what's sort of happening is that one, they're growing. We want to have access to that growth. There are sort of, instead of one monolithic thing, there are sort of probably three distinctive zones in the emerging markets. And I think our managers and, you know, and our team, you know, should have the ability to sort of tactically allocate, you know, among those three regions. Those three regions being that sort of China, Miaza, and Latin America. And I think that they're, again, distinctive. They have their own politics, but it's the growth piece that we really want to capture.
Thanks, Russell. Doug.
I just think this is a much longer conversation. I think I would just echo what Tom said. I think holistically, abandoning the second largest economy in the world from a policy standpoint seems ill-advised. But it is a much longer conversation than we have time to discuss here. I think we need to have a specific IFC conversation on this before we come with any recommendation.
Thanks, Doug. And I see a thumbs up from Ken, and then I have Dick too. So, Ken, anything?
No, no. Doug it's exactly what I was going to say. I think we need to have a very specific conversation on this.
Good. And Dick, thanks. Good to see you.
Yeah, I'm sorry I couldn't get on earlier. I'm on travel and using somebody else's computer, so I had to get it to work. I feel the political and economic tension between the US and China is undeniable, and cutting back the exposure in the short term is a very smart idea. But in the long term, China is not going to be the second largest economy. It's going to be the largest economy in the world. And you can't ignore it and shouldn't ignore it.
Okay, thank you.
Mr. Chairman?
Mr. Treasurer.
Yeah, I think if we maybe do an analysis on and start moving away from indexing and more active management, and maybe one of the I guess areas that I think I would look like to look at a determination is look at the volatility of the countries that are in there in relationship to the volatility of the whole index. And I think if you look at China, there's a huge difference between the volatility there. So you know that you have more risk involved, and that if you're going to get the inefficiency of the market, you're going to have to use active management rather than an index. And that could be said, I think for other countries that are within the index. I like the suggestion that Russell said, that there are different areas around the world that you could trifurcate the index. I think if looking at China, because of the volatility and the problems that are there, I would think that we're probably gonna end up with saying take it out of the index, develop active managers at a small capital contribution to get the relationships, I guess, developed. So if the possibility exists that we want to put more capital in there, that we have those managerial relationships and the expertise in that area. And so I think that's probably the way that we'll probably end up, handling China. But I think that we do need to do an analysis as far as the volatility compared to the index of the different countries, because there may be a couple of outliers, nothing like China, but there may be some other areas where active management would be a way that we should proceed and work into a little bit more of a niche markets in the index and find some inefficiencies.
Thank you, Mr. Treasurer. I see Russell has his hand up. Russell, before I recognize you, that's sort of been an argument that I've had about EMD for a long time. Everything has been related to China because it's just so massive. But you have all these great economies like Brazil and others that can be kind of interesting places to play, to the Treasurer's point. Russell.
So thanks. Definitely along those lines, the emerging markets are quite a bit less efficient than Europe and particularly the US. And as such, the rewards for active management in the US are, have been less. It's a difficult game to outperform, a U.S. large cap stock index with other U.S. with different weightings of U.S. large cap stocks. With the emerging markets, it's quite a bit different. There have been managers with persistent outperformance of the benchmark. So the benchmark represents something very different for the emerging markets. It's something which is beatable. Certainly in, the appeal for active management is greater for the emerging markets. So the ability to tactically to tactically underweight and overweight has been greater, and it's been true for a long time. It was noted there was a period of about 10 years where about 85% of the active managers outperformed EFA. That is Europe, Australia, and the Far East. That was the international index of its day. And the reason there was that there were systematic underweightings generally of Japan for a decade. That was a good underweighting. And so you could do things even then that would show, rewards to active management. We just haven't seen as much in the US. So just underscore that, there are rewards to active management in the emerging markets in particular, which are generally a good idea. And so these systematic underweightings and overweightings can pay off quite a bit more.
Thanks, Russell. So Patrick, I think, good discussion. Look forward to what the IFC comes with. But we also have other things to do.
Yep. So, Mr. Chairman, this would be something for the June meeting if we can get this conversation, and if not, then we'll have to push it back. But I just wanted to bring this up to make sure that we're in agreement that it should be discussed.
I would take that as a consensus. Mr. Secretary.
Mr. Chairman, I'd like some conversation in the IFC, what a full divestment would look like, or and what the spreads would be. I don't think it would just be simply replace it with India. I mean, that's a little too broad. So, there's got to be some way to get a more diversified approach that would achieve that. And I'm obviously I'm one opinion here, but I think that there needs to be an understanding on how you achieve that diversification in different scenarios. And that's one thing I'd like you to look at. Thank you.
Thanks.
Mr. Chairman, the state agency pool on the agenda.
Yep.
Real quick, we've already discussed this, what we're looking at and that's page 55, I believe.
35.
Okay. I had 50.
Oh, it might be as a part of bigger deck, yeah.
Okay. Which is this diagram of the different, there we go, of the different allocations. And so what we're talking about is right now, all of the things that we were trying to do, combined portfolios, all of these different things that we've looked at is to try and enhance yield without taking significant amount of risk. One area, as we all know, state agency pool ran into serious problems. It had emerging market debt, had some other things. The agencies within SAP are not able to take a loss. And so what we worked hard with the legislature to set up and saying, okay, what could we do? What we did is we bought US Treasuries, put them into a ladder, a 1, 2, 3, 4 year US Treasury ladder, bought them at a discount. And we said, we will not have a loss on those securities as long as the US government does not go under or default on its payments, which is another story. Anyway, the difference that we're looking at is saying right now, spreads are very tight, but we think that if some of the things that we talked about, that there could be an opportunity for some spread widening and potentially to take just a little bit of risk. And so what we talked about is potentially having maybe up to 20% of this portfolio allowed to go into corporate securities or non-US Treasury securities. So if you look at the graph on the upper left, what we're talking about is if you can see the rating year, AAA, AA, single A, all have a 0.1% or lower loss rate if it's less than 1 year. And so if we were able to invest in corporate securities down to a single A, we would have a 0.1% or less loss. Conversely, on the top line, the AAA securities, which are basically sovereign supers, agencies, et cetera, other government, other countries, World Bank, et cetera, the AAAs, you could go out to, the same 3 or 4 years and buy a AAA security. If history is any indication of the future, typically spreads widen out, and we feel that we could add somewhere between, kind of an 8 to 10 basis points. This is a $5 billion portfolio. It'll be less once the reserve accounts come out, it will be less than that. But it's a significant amount of money, and we are dogmatic about trying to get every additional dollar to the funds as possible. So with that, if we limit corporate exposure to, so again, this is just a big proposal. We'll have a firm proposal in June, but, saying, 1 to 2% of the portfolio, single name limits. We'd have a single amount that we could do, but this would just be another opportunity to add a little bit without taking significant risk. And we can do the analysis on it is if we had an SVB who was single A and who went under in a very short order, how would that affect, and would there be a loss, or would we have enough income on that instance if we did have that loss with that very small percentage to limit that? So that's the big picture of what we're trying to do. And this has really come about numerous legislators, numerous other individuals. They wanted to put a spending policy. They wanted to put a reserve account in the SAP. This is a cash account. This is the basically checkbook of these agencies. This isn't something that you put in long-term and needs to be extremely liquid and readily available. We've also done limitations. Dick Granis pointed out how much income potentially would they need. We could hold enough cash reserve. It's approximately 150 million to make sure that if there was any one need, if the Water Development Board needs money, we'll have that available. So we've gone through kind of a litany of different things to try and mitigate any downside risk.
Okay, thank you. Patrick, questions on that? Bob, Representative Nicholas.
So I think this is on CapFin's agenda to do the same thing, and they're recommended. Also, my understanding is if we implement this, it'll be an opportunity to get out from under the ladders over time, which would be a nice thing as well. Is that correct, Patrick?
Mr. Chairman, Mr. Representative, yes, if that is something that we wanted to do, the problem with getting out of the ladder is that if you had, similar to what we had before, where we had a downside move in the markets, then if it was outside management, we'd have a problem because they don't care. They could have a loss, even though it would be short term, but they could have a realized loss. But when we're getting out of the ladder, this is kind of our proposal saying, we don't have to go to 4 years, but it's kind of, if you go back in and study it, this is a good area of that through all steepening and flattening episodes. That is very good. But this is kind of the first step of moving on from a very secure U.S. Treasury into something else.
And Patrick, from my standpoint, I'd like to stress test this against probably not the COVID shock, but where we lost a third of our income, but just to understand what that is, because there's a cash flow component to this that could be very concerning. So perhaps as part of that CapFin discussion, we can kind of work with you to sort of talk about what fail-safes might be in certain situations. Yeah, okay.
Mr. Chairman, next on the agenda would be the risk management update. And part of this is Marty Chikandi is going to give a presentation on this, and I'm going to talk a little bit about it. But this is something that we have already rolled out. And just to give a background, when we started here, we did not have any risk systems whatsoever. We had our external managers running our risk analysis for us. Our returns, we would get on a 1.5-ish month, about a 6-week delay, understanding where it was. So this was part of our Aladdin risk system, which is state of the art. We were able to get this for free, which is approximately $600,000 a year. But part of our investments in the private equity investments, we were able to tag that along. This is a significant part of our work. It's extremely complicated and hard to implement. Madi has been working nonstop on it. Because of our need in the fixed income side, that's the first module that he has implemented. And now just recently, we've been able to get the equity part on to see the risk. And the next phase is to get the alternatives, which are problematic because we do not get real-time data. Most of the privates do not report until multiple months after the quarter, but to have private market surrogates to just give us an example of where we are, what happens, to make sure the managers are doing what they're saying they're doing. When I see movements in the market, I can see this and understand what's happening. So with that, I would want to pass it over to Madi to just basically give you kind of a background of these things. And the very beginning of it is really kind of definitional, because this is not your basic, it gets more complex. And so I want to make sure that all of you understand some of the terms and how they're used first before we get into the meat of it. So you can understand where we are, especially with our internal investments, and make sure that you have the comfort and knowledge that we know where we are on our risk spectrum on a daily basis now, as opposed to a 6-month or 6-week basis. So with that, I'll pass it to Madi.
Thank you, Patrick. Mr. Chairman, members of the board, I'm Madi Shikandi. I'm the risk officer for the State Treasurer's Office.
Just pull it closer to you.
Okay, sure. And then, so the objective of this presentation is going to be, as Patrick mentioned, to give some background information about the risk report that we use on a daily basis. So we have some risk measures in these reports that I'm going to define. And coincidentally, I will also provide some background information about the risk part that Josh actually in the RVK presentation reported. So we'll talk about the normal distribution, the fat tails, and how it's going to actually affect our risk. And I think a good place to start is by reviewing the risk guidelines in our investment policy statement. And so there are 2 instances of risk in our IPS. One is actually about our overall equity risk, which is compared to a benchmark portfolio, and that benchmark portfolio is 70% global equity, 30% domestic fixed income. And then the second mention of the risk is our total portfolio level for our pools. And I have brought an example from our permanent mineral trust fund here, which more specifically states that the annual losses greater than 22% of our total portfolio value, actually on a confidence interval of 99%, should be less than 22% of the portfolio value. And so I'm going to actually, in the beginning, point to 2 notes here. So one is that in the reports that we are going to review at the end of this presentation, the risk of portfolio might seem too low, too large, but that should be actually compared to the benchmark, as in here we have the first case. In the second case, where we are talking about the absolute risk, it is also good to mention that the way that we have implemented risk in our office is actually on a more granular basis. It's on portfolio level. So the risk of the individual portfolios should not be actually directly compared to this risk here. And that's because of the diversification effect, which actually will bring the risk a little bit lower. And that's a topic that I will actually come to it at the end of the presentation. So with that, I think it's good to review 2 primary risk measures. One is actually the variance or a standard deviation, which is actually just the square root of variance. And then the other one is the value at risk, which I'm going to define in the next slide. So this standard deviation actually became popular as a risk measure by the work of Harry Markowitz and others in the modern portfolio theory. And a common assumption in this theory is a normally distributed actual return. So in this theory, we assume that returns of portfolio and individual securities are normally distributed. And since this normal distribution is an important concept, I'm going to actually explain it a little bit more here. So first of all, this is a probability distribution. And the probability distribution just shows us what is the likelihood of getting any possible return. And the normal distribution, which has this the shape of a bell curve, it has some properties. For example, the expected return is in the middle. That's the most likely outcome. And then the probability of very extreme losses or extreme profits is actually very low, as we can see on the tails. And what we can see, I can also explain what standard deviation is using this normal distribution. The standard deviation basically shows the variability of returns about the expected return. And as we can see, standard deviation is also called sigma. So 68% of the time, we would expect the returns to fall in one standard deviation or one sigma. And 95% of the time, the returns would actually fall in two sigmas, and then 99% of the time within 3 sigmas. One primary application of the standard deviation is in portfolio optimization, which actually is used in our asset allocations, for example. So to recap, standard deviation just measures the variability about the expected return. But the next measure of risk, called the value at risk, also called VAR. So this is about downside risk. So I'm going to give the official definition for value at risk first, and then I will explain what does that mean. So VAR is defined as the predicted worst case loss at a specific confidence level, and examples are 90%, 99, 95%, and 99%. And we have to also specify a certain time period, which usually is 1 day or 1 month or 1 year. And to explain it, it's best to go back to that normal distribution. As you see, well, let's assume this normal distribution is showing the returns, daily returns of a portfolio. And let's assume also that that VAR number corresponds to negative 10 million, for example. And then as we can see from this distribution, 95% of the time, the portfolio return is going to actually be larger than that negative 10 million. And only 5% of the time, we are going to exceed that loss. As this definition shows, this is exactly what we wanted to have, and what the definition was in our IPS. So we think actually VAR is a good measure of risk to use in our risk reporting. And besides that, VAR also has other characteristics that makes it actually a flexible risk measure, and we would like to use it in our risk reporting. The first and foremost, actually, probably the most important one is that VAR applies to different asset classes, and the interpretation is the same. So it can be applied to stocks, bonds, and derivatives, and the interpretation is the same for all of them. And the next one is the time horizon that can be changed, and we can apply it to a 1 day or a 1 year, as it was specified in our IPS. Confidence level can also be different. Common values are 95%, 99%. This can also be represented as a percentage or in absolute currencies like US dollar. And it can be also calculated using 3 different methods: parametric historical simulation and Monte Carlo simulation. And so the parametric one is the most simple one. It's a fast calculation. So usually for trading purposes, that's the method used. But historical simulation and Monte Carlo simulation are mechanically the same. The difference is that the historical simulation uses actual historical scenarios to come up with a distribution, but the Monte Carlo simulation uses hypothetical scenarios. Probably the most important thing is actually that VAR is basically the gold standard in risk reporting, and all major financial institutions have adopted VAR. And that's why we are also using VAR in our risk reports. One important distinction between two flavors of VAR is that there are two types of VAR that we use in our reports. One is the standalone, and the other one is the marginal VAR, also called incremental risk or risk contribution, as it is called in BlackRock Aladdin. And I guess the best way to explain the difference between these two VAR measures is to look at these two metrics for one of our actual portfolios, which is actually our small cap quantitative portfolio. So this portfolio has exposures in different equity sectors. And for example, if you look at the communication services, and the standalone VAR reports the risk in isolation. So the 11.22 basis points, which is actually 0.01%, that's the risk of the communication services in isolation. But if you look at the risk contribution, it's actually less. It's 10.38 basis points. And that is because of diversification. So the risk contribution takes into consideration the diversification effects. And that's basically the correlations between the securities in the communication services and other securities in the portfolio. And so one property of risk contribution is then that the sum of individual risk contributions equals the sum of the portfolio risk. And so that makes it a good tool for risk budgeting. So that's one purpose of risk contribution. And last but not least, I wanted to actually also emphasize one of the disadvantages of VAR, or one of the shortcomings of VAR. And that was also mentioned in Josh's presentation, that we are not expecting the returns of individual securities or portfolios to be actually normally distributed. And empirical analysis of market returns shows that actually those returns are not normally distributed. And it might be actually, the normal distribution might be a good approximation in positive extreme outcomes, but for negative extreme outcomes, the downside risk, the normal distribution is not a good approximation because it actually assigns a very low probability to those events. But as you see, the orange line shows a more of an actual distribution, which shows that actually the probability of those extreme negative events are larger than what would the normal distribution imply. And it is also referred to as fat tails. So that basically says that actually the probability of a negative income is more than what is predicted by normal distribution. So, but as we saw, VAR actually assumes that returns are normally distributed. So in this case, the best practice is to just reserve the VAR for 95% of the time, which is also the normal times, the normal market conditions. And then for that remaining 5%, use stress testing, which are basically the custom market scenarios. And examples are an economic recession, a market crash, and scenarios like that. So that concludes the introductory material. And if you have any questions, I would be happy to.
Are there any questions? Mr. Treasurer.
Yeah, and I guess, Monty, this is to you, or Patrick. If you can recall, what was the sigma move, the largest sigma move that in recent times that you can remember? On that March 20th, was that like a 10 or 11 sigma move, or I don't know what it was, but that gets to the discussion that we have with the fat tail. And when you have these things that you don't expect, you don't plan for, just how much you can lose. And I kind of go into that Alberta Management Company when, and Patrick, you love this, it's like they were picking up pennies in front of a steamroller, I think is what you said, and they lost $2 billion overnight in a options trade. So I'm just wondering some of the some of the horror stories that you might be able to relate to that you've seen and Patrick, that you might have seen more than any of us.
Yeah, exactly.
Well, the one thing about it is, as soon as you go past that 3 or 4 sigma move, it's really irrelevant because, you're talking about the 99.99 percentile or what have you, you know, 1 in a million year flood. And so as Marty, the main part of that is that fat tail component, because most of the normal distribution, you're looking at this, but we know that the downside risk is much greater. So in 1987, you had a 23% drop in the S&P in one day. You don't see a 23% increase in the S&P in one day. So that's that fat tail phenomenon. On the left, tails are fatter than the right. But like some of the biggest ones that I've seen is long-term capital management. I don't know if you remember, all of you, that, but they had this bet on Danish mortgages that went out to 6.5 sigmas. And basically when you get that far out, you're toast. And they went under just because of their leverage component with that kind of a loss. But you'll see these one-day moves and so forth, but for, that can really move out there. But it's really that the first 4 is really kind of the max that you would want to look at. And when this whole relative value stuff that we do is looking for that mean reversion. So when it gets out to 2 to 3, that's like the warning sign, beep, 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 rich or cheap. And then just like what I talked about with the index movement in bonds and equities, we are out to 3.3 sigmas on that one. That was way too wide. We hadn't seen that since 86. We knew something was going to happen. So that's kind of how we use it.
Marty, I have a quick question on using VAR. Can you also look at it geographically? So in other words, across all assets in Europe, can we also use VAR for that?
Sure. So actually, value at risk, or VAR, is actually an approach, basically,
right,
that can be applied to many different actually phenomena. So it is also being applied to credit risk and even operational risk. So definitely, yes, that's something that, and the advantage of it is that actually it can be directly compared to the VAR, for example, here in different geographies.
And my thought there, and I think this is where you're going, is that we'll be able to track across all portfolios,
exactly,
all of these considerations.
Exactly, that's
Excellent.
exactly right, Mr. Chairman.
Mr. Chairman, we have a demonstration to just show you what Marty has put together.
Yeah.
And I know we're rushing on time, so we'll make this very quick.
That's the Excel for the equity. Yes, please. So this is one of the reports that we actually generate and monitor on a daily basis. This is our equity risk dashboard, and so the example that we wanted to actually go over is our broad U.S. equity, and as you can see, I mean, yeah, probably. Perfect. That's better. So on the report, we can see the market value. So currently we have 1.872 billion in our equity bucket. So we can also see the market value percentage. So that's useful. If we actually just expand those, we can see what is the components in that bucket. Then we look at 1-year risk. This is mostly because to comply with our investment policy statement. So we look at the 1-year risk, the standalone, and also the risk contribution on a 1-year time horizon, 99% confidence interval. We also look at the 1-day risk, which is a little bit to the right. So that's actually mostly used by our portfolio managers. And that also gives some sort of alert to the risk management and also CIO. So for example, if the risk is actually breached more than 2 sigmas, then we will be alerted. And the other things that we look at are those stress tests scenarios or market scenarios. The ones that we look at on a daily basis are, one is actually when the market is down 2% in one day. And as you can see, I mean, if the market is down 2%, the broad US equity portfolio is down 200 basis points, which is basically, again, the 2%. And the benchmark is down a little bit less. But if you look at the active risk, and in that scenario, it's actually 0.04 basis points, which is basically zero. So we are in line with the benchmark risk. And then for the other scenario is actually the GFC, Great Financial Crisis in 2008. And so that's a longer term period scenario. It's about 1.5 years. And in that case, as we see, I mean, the portfolio might actually lose 24.88%, but the benchmark would lose a little bit less. But and then our difference with the benchmark would be 9.91 basis points. So that's actually less than 1/100th of a percentage point. The other metrics that we look at are how liquid our securities are, our portfolios are. And as you can see, SEC provides liquidity buckets, and almost all of our securities fall under the highly liquid bucket. So that means actually we can actually liquidate them less than 3 days. The other metrics that we look at is actually our return, which as you can see, we look at a day-to-day return, weekly, monthly, and fiscal year to date. And I will go over quickly for the fiscal year to date. As you can see, I mean, the broad US equity portfolio is up 7% and 7.73%. But the benchmark is up 7.87%, and the difference is about 13 basis points. But as I mentioned, we have implemented this risk system at portfolio level. We can also, and this is a bottom-up approach, we can also look at the securities, actually see how securities are doing. But this is what we see actually on a daily basis every morning. And we have information about all our portfolios at this moment.
So, Mr. Chairman, just big picture-wise, so Marty is our risk officer, so he has implemented alerts. So if something's happened greater than 2 sigmas or whatever, boom, boom, he alerts. I get this every day and I look at it. So I don't know, I just love this stuff. So this is what, I see all these different things, and, I look at these risk metrics. So our managers say, oh no, we're doing this, this, this. I can look at this report, and if the market's down 2% and they say, oh, we're not taking this risk, or we don't have this credit risk, or what have you, I can look at it and see if they're actually doing this. This is something, just so you know, this is like what the state of the art, the best investment managers in the world, this is what they use, how they look at things, how, I used to look at things when I was doing this, and every day I can sit there and look at it and say, okay, well, week to date, we're up 16 basis points. Okay, what is Seth and Fung doing in internal small cap? Well, it's 82 million. It's, this is a small exposure or whatever. They're plus 11 here on the day, 14, but they're up, 2.2%, 226 basis points on the day. So these are the metrics, and this is just like the broad overview. As Monty said, it's like an onion. We can go through. I can look at each one of their exposures. What are they exposed? What is their banking exposure? So, for instance, you had all those banking problems. I can go look in who's overweight banks, who's underweight banks, things like this. It's just extremely helpful in understanding. And before, as I said, well, Governor, where we were, when you started this process years ago. I mean, this is so far advanced from where we were and what we've ever been at. So all of you, you're in charge of understanding what we're doing. And I just want to make sure that you understand the systems that we're doing. And fixed income, it even goes into more depth. So we can look at what's our carry, what's our, Cheryl looks at this every single day. Caleb looks at it every day. Where are our buckets? And, we're underweight 1 year, 2 years, what have you. No, we're back to neutral weight on it. So we know every single part of the security. What's her horizon rate of return? Are we positive carry, negative turn? Where are we going to be in 6 months? It's just an extremely sophisticated system that allows us to go through every single, all the way down to the single security level. Like if you wanted to see our exposure to SVB, we could have pulled that up. So this is something that is completely different than what we've ever had. And the reason that we're talking about it today is just to let you know, this is something that we spend a significant amount of time. Marty has done an unbelievable job. And, most people do not have, somebody who can program in Python and C++ and do these things and implement it. So it's just, I just think, tremendous situation that we're in, and hopefully you feel comfortable with where we are and where we're going.
Well,
Any
thanks.
questions?
Yeah, any questions? The next time it would be nice, Patrick, if you showed a little enthusiasm.
Well, this is between what you're doing, the IFC, the legislature. I just think, when, the Venn diagram, when we have it all coming together, it's so nice to finally, giving Katie the back office and the ability to actually, be able to monitor all these things on the accounting side. Now she has a real staff and systems to be able to do it. And the same thing with us.
Yeah. Well, Marty, thank you. I know where you started with all this stuff, and it's been a while, but it's fantastic. Thank you.
Sure. Thank you, Monty did do an excellent job on this, and it was painstaking, I know, because it takes a lot to get it all together. But just so you guys know that Patrick has been with us for 10 years, and we celebrated that the other day. And he actually looks like he can see light at the end of the tunnel now. So,
Well, and I think the addition of Aladdin has been very helpful in this. Is that a misstatement?
It's a game changer. I mean, literally, we were having our managers run that risk report for us, and their system was basic compared to this.
Right.
They didn't show anything that we had.
And Mr. Chairman, we get that as a result of some fairly aggressive negotiating with BlackRock that happened. And so we're getting, what is this? If we were paying for it, is it $500,000 a year?
$600,000 a year that we're saving by having the negotiation that we did with the investment.
Right.
Yeah.
Mr. Treasurer, thank you for making that point. It's a very important point, particularly considering ESG. So thanks.
Thank you, Mr. Chairman.
So, Mr. Chairman, that leaves us with the last one, the ESG comment. I'm going to pass that back to the treasurer. It should be the last page of the presentation in some of.
Well, Mr. Chairman, I hope that everybody's had the time and looked through this. I can kind of give you the 20,000-foot version is how we came up with the way we're looking at it, and that we have gone through and got the input of the IFC during our asset allocations, and essentially signed off on the Florida aspect of using pecuniary and non-pecuniary. And so I wrote it, sent it back out. Russell Reed came in and further refined it. So when we were talking about the prudent, being a prudent investor, went into the definition of prudent investor as it's defined in 1992 in the restatement of the law of trust. So anybody that looks at our ESG statement can essentially go, if they want to know what a prudent investor is, they have the way to go right to that area and find that out. I think that there's a couple of things too. That one is just the statement is, which would go on our website, and I think these things are you know, they're, from my perspective, they're my opinion on that. And the areas where I do get into the opinion a bit is where we talk about what pecuniary factors do not include. The social, political, and ideological interests are exactly what Florida uses. And I opined a little bit about non-pecuniary factors do not provide confidence in increased returns or lower risk. I don't believe they do, and I think conversely that they may be cause for alarm and concern. And I think that if a company is having their time diverted by non-pecuniary diversions from their fiduciary responsibilities, then they're not going to be keeping their eye on the ball, may very well result in lower returns and increased risks. And the simple definition of pecuniary or non-pecuniary is that pecuniary means having to do with money. Non-pecuniary means having not to do with money. So it's anything that a company would do that would necessarily, as I said, take their eye off the ball, doesn't have anything to do with returning money back to our state portfolio, and would basically, it adds no value to what we're trying to do, and that's to get the highest risk-adjusted return. And that's the common denominator in all of this, and that's a statutory provision that we have, is to get the highest risk-adjusted return. And so we go right back to that. And I think that in the areas that we proposed into the investment policy statement, in a couple areas, we basically define what we'd like to change there as our investment partners, what we expect. And we also go into, you know, what the treasurer's responsibility is, and what we would do as far as if we find out that we have our investment partners that are acting in a way that that's not increasing our returns or lowering our risk or both, then that what I'd have the responsibility to do is communicate and request that they change the policies. And if we get no action there, then actually we go into our next phase of to voting proxies to hope to force or change the actions of our partner. And if that doesn't work, Mr. Chairman, then we're really faced with either divestment or replacement with competitive alternatives. And it said, ultimately, all partners must adhere to the standard of care of being a fiduciary. And if you're acting in a non-pecuniary manner, you're not acting in a fiduciary manner, because you're not trying to get the highest risk-adjusted returns. You're not trying to get the most money coming back to the people that are essentially giving you their money for you to invest or manage. Going on to the proxy, I wanted to make that fairly straightforward, that the state treasurer has the duty to vote and manage all proxies on investments, and expected to vote the proxies in a way that is consistent with the whole of this investment policy in accordance with the pecuniary interests of Wyoming's portfolios and the state of Wyoming's financial interests. Now, that steps out a little bit outside of investment policies. That steps into the realm necessarily of where I think BNP, I won't use a banking name, but a bank that was essentially not allowed to participate in the time deposit open account program, where what they were doing in their management of that business essentially was detrimental to the overall general economy of the state and the ability of the state to essentially continue their development of natural resources, coal, oil, and otherwise. So it was a situation that was, I wanted to include in here to essentially in a dire circumstance that something like that popped up again, that we would at least have an opportunity to communicate through the proxy process. I say that we may hire a proxy manager, and in talking with the CIO of WRS, we actually feel that it's more likely than not, if we go down the proxy road, that be most beneficial, I think, to share a single proxy manager, that we don't have to employ two of them. There should be, I think, an economy of scale there. And I think that that would probably be shared on basically assets under management of publicly traded funds, or where a proxy would be voted, and that's how we would probably split that. Indiana just, I think they've got 30-some billion dollars of assets under manager. If you look at the pensions and investments magazine, they had, I think they paid $150,000 for 30 billion of assets under management. So that's and I think Patrick's done some work that is somewhere between 50 and 100,000. So if we look at the WRS, I think we're going to probably be less than 100,000 for the both of us, is what I would think in that regard. I say the proxy manager would be overseen by the Treasurer's office and make semi-annual reports of its activity to be posted on the Treasurer's website. Speaking with some of the people that have hired proxy managers, they do an annual, they're reporting annually, but I think that that we can probably do it semi-annually. I'm not sure whether that's going to be a costly addition rather than just doing it annually. But I think that most of these folks are doing it semi-annually. So that's where I hope we can go. If you look at what some states have been doing, they've been adding a penalty provision that's essentially making it illegal with fines up to 3 times the I guess fines up to 3 times the salary or the amount of money that we pay in management fees to a manager if they violate what would be a subjective ESG standard. I think that we've got it fairly well nailed down to where we actually have to identify that there's a potential loss to the portfolio or to the state. So that, Mr. Chairman, I think it's a non-starter from my perspective, because I don't think any of you guys as fiduciaries would like to have your salary, a fine show up to you at 3 times. I don't know what judge would actually implement it and actually cost us to do that. But if it's in the law, you never can tell. And the same thing, I think it'd have a chilling effect in hiring managers, chilling effect with keeping employees. And I think there's about a dozen states now that have something close to that already enacted or contemplating it. And that might very well be a very good fishing hole for some of the positions we've been trying to fill. But I'd stand for questions, Mr. Chairman. I think we're getting it to in the right way. I think it's a stair-step thing. We're not going to be being cowboys and shooting and asking questions later. We're going to actually define, that we have a problem and try to characterize what that cost might be. And in all these cases, you have that last decision about whether or not it's in the state's best interest to deal with someone who's maybe a little bit of a bad actor. There's some people that I don't think that we can replace in areas like custodials and things like that. There's not one bank out there. We were looking at that discussion during this legislative session, and one of the banks that we thought, I think, was Deutsche Bank, and then they had problems. You know, as far as you gotta have a bank with enough deposits. And JP Morgan, as we've seen step up in this banking crisis, you know, they're about as solid as you're gonna get, and that's who we use.
Thank you, Mr. Treasurer. I think really good work. A couple of thoughts, and I'll open it up. One is Wyoming also has a statute that references the prudent investor rule. I don't know if you want to incorporate that in your statement. I think it's really good, and particularly valuable in that, in my mind, is the conversation about the fiduciary aspect, because pecuniary on its own, just as you point out, just means money, which, you know, if it's more money going out than coming in, it's still pecuniary, and that was the problem for me. We want to make sure that we're doing the best we can. Well, what I'm saying is pecuniary just refers to what happens with money. So if they're making investment decisions that have a negative pecuniary effect, it is still a negative pecuniary effect.
Okay.
And if it's a fiduciary, you're going to be trying to do the best that you can.
Yeah.
I think you defined that beautifully in your statement. The question I have is on the proposed IPS language, and if we can put that there, so it just really both implies the fiduciary. And I know the reason why they don't like fiduciary is because they say, well, climate's a huge issue, and by golly, we got to do everything we can, and that's not fiduciary if we're not doing it, which is nonsense.
Yeah, and they're going to do that in California. That the last group that came on at that meeting I was at was all about ESG, and what they're going to do in California is they're going to redefine fiduciary, and they're going to include climate as something that you have to do in a fiduciary context. And within 3 years, that's going to be basically every building in California that's a commercial building. You're going to have certain climate standards on it. If you don't have those climate standards within 10 years, you can't rent the building and you can't sell the building.
Right.
Until
It's just,
they're done.
this is awful.
Yeah.
And,
Yeah,
you
it's-
know,
it's insane
I
out
don't define fiduciary as freezing in the dark, compelling people to freeze in the dark. So, but I thought that was great. The last thing I just wanted to ask, you know, if you're going to put a proxy manager in place, that's great. I don't have any problem with that.
Right.
But I just wonder if they could report their proxy votes. The managers could report their proxy votes. And then we just compile those. So we sort of understand. I mean, I know that's bazillions of them, but
And there's
not a reason to do
there's
that,
at least two what I would call ESG friendly proxy managing companies coming up. One Strive, another one was a new one that showed up at our SFOF conference last week. The part of the problem we've gotten a lot more flexibility in voting our shares in some kind of a block aspect. And this has happened with BlackRock, with State Street, other areas. But the problem that you would have essentially is that even though that they're going to vote your shares that way, when these huge institutions come into a corporate shareholder meeting waving, we've got this many votes, the people sitting in those desks or in that shareholders meeting don't know how they're going to vote those votes. And so they still carry that huge bullet pulpit stick when they walk in the door. So I think kind of the move is on to try to use proxy managers that when they come into the room, the people know which side they're on of the deal, you know, so. Yeah.
And then this may get a little technical, and Patrick, you can correct me if I'm wrong, but I think most of the managers, and I'm not sure they're still doing it, but they used to load up all the IPS stuff in Charles River, and then they'd run Charles River compliance reports. And I don't know if that was always one of the things that I was trying to get some sort of dashboard on what the hell they loaded up and what the hell they did with it. So
Yeah, Mr. Chairman, I don't know, Josh, if it's Charles River that they loaded into, but yes, they have to comply to our IPS. And who the, I know that it was Charles River, but I don't know if they still do it now, but they have to comply with our IPS. That's part of our contract.
Yeah, okay.
Yeah, and Mr. Chairman, I think that's, some of these things here, I think, whether or not it needs to be in the IPS, but I think, you know, that might be well one that rather than just, if there is a reporting agency that will report how these different firms are voting in which areas, that would be, you know, I think then the board could have actually monthly or quarterly, necessarily the public gets it twice a year or something.
Yeah.
Okay, Martin.
Great. Comments? Questions? Mr. Secretary, did you have one too?
Well, thank you, Mr. Chairman. I mean, I've been pretty clear. I'm very opposed to this ESG, and I think we need to take action here. I think, you know, looking at this, there's maybe some things we can strengthen a little bit here, but it's a good start. And I think at the end of the day, you've got to have some strong language on the proxies, and then also the ability to divest and what that procedure looks like. Because the last thing I want is them to say that they're inaccurately, by the way, that for them to inaccurately say that they're being a fiduciary by taking into account these things, which is their argument, as you talked about. And then, you know, they go to their boule cheese fluted glass parties and just say, well, we found a way to get around it. And you know, and they look down. A lot of these folks look down on us, and they're gonna try to find any way they can. So we've got to make sure it's tight, and that we have that ability to divest, and what that procedure looks like. I think that's key.
Mr. Chairman.
Madam Superintendent.
Thank you, Mr. Chairman. I would just echo, I really appreciate the work of the Treasurer's Office on this. I know you've been working on it for a while, and, you know, of course, absolutely oppose these ESG policies as well. I've made my entire living off of companies that they're looking to attack. And I'm really excited about companies like Strive that are really working to provide these kind of services and really bring a lot of states together, because I think in this conversation, it's really going to take several like-minded states, you know, standing up against this. And so I'm really excited to see what, you know, them and others in that similar boat end up doing. So appreciate that.
Yeah, I think we had 37 states write a letter and sign a letter on the mortgage aspect that Biden is trying to do, is charge people with better credit higher interest rates and give a break to people with lower credit. So, you know, and I think 2 years ago when the SOF was first there, I think we had about 12 states. And so this thing is really picking up steam. Yeah. And they're starting to get a real good, I guess, bench too, you know, where it was just a couple of three people. You know, they've got a good bench in different areas. They started up a 501c4 so they can do a little more political action. And so it's I think it's on the move.
Yeah. Well, and I just a cautionary note, you know, the one piece is environment, the other piece is social, and the other is governance. One of the rich targets for private equity is bad governance. So, you know, if you if you can go in and straighten out a bad board, that's good governance. So, but.
Well, Mr. Chairman, I guess I'd say I'd invite any, you know, friendly amendments to this. If there's things that you guys see in our letter that needs to be in the IPS, or any identification or any glossary that we might want to put in there, you know, let me know and extend that out to our legislative liaisons too. So I think that we can get a workable ESG functionality within our IPS, because as Patrick said, is that everybody that does business with us has to adhere to that IPS. Right. And that's why we're putting it in here. One of the things that I didn't quite get to that I want to circle back to is there's an area in our IPS, a standard of care, and there might be an area in that needs some attention. And that might be where we can put some of these other things that we're talking about. So I welcome any input, especially in that standard of care area, because I just haven't had the time to put a lot of attention to that. And that might be where we actually identify the standard of care, and the proxies and the manager's thing is the hammer, and the standard of care is maybe we can get into more of the requirements.
Mr.
Madam
Chairman.
Auditor.
Just a question. I think we all understand and appreciate the intent of the proposed policy. I guess my question is, and going back to the importance of being able to divest things, I'm always just cautious of the wording we use to make sure it doesn't, have unintended consequences. This wouldn't impact our ability as a board or an investment manager's ability to, for example, divest from China if they felt like it was the right thing to do, even if it was potentially not. I just want to make sure that pecuniary language doesn't limit our ability to make some decisions that may be more multifaceted than just financial. And I think of getting, divesting of some of our Russian investments. Well, those don't really count because those were also in the toilet. But I think the China conversation is a little bit different, where some of those may not be losing money, but we may say, you know what, no, we're too risky for other reasons. And I just want to make sure that we aren't impacting our ability to make those decisions.
Yeah, I don't think we are. I ran this by our attorneys, and that didn't pop up. And when we divest of things that several times when we've got a manager that just isn't performing. We go through a process, and it takes a while, and we have some ghost accounts there for a while with a few dollars in them, and then we get rid of those. So.
Well, and functionally, I mean, this board makes those ultimate decisions. They can redeem a fund entirely, but we are the ones that say we're going to close it. So I think it's great to have the policy statement. I think it's incredibly important, but it isn't a programmatic thing. I mean, if the treasurer comes with we don't think this makes sense, for a number of reasons, I think we still reserve the right to be able to make that decision. So. Very good. I have Representative Nicholas and then Secretary.
So a couple different things. First of all, I think that I have some of the same concerns with the use of the word pecuniary, in particular because then you go in and you define it. But the definition to me is not technical. So I think if we're going to use a pecuniary, that we have to define it and make it a term of art that applies in all situations. And so it's just something that we need to work on. It's just an incomplete definition right now. And we talk about what you define as non-pecuniary, some of those things, social, political, and ideological interests, actually can be very pecuniary. I mean, if we invest in a company that is a pro-green company, because that's what their product is, but they're using materials from the state of Wyoming and it's creating windmills or whatever it's doing, we want that to happen. And so by the way you've got this term described, you're saying you can't do that. So I think it's incomplete and not it's just not. That's just something that has to be worked on. Kurt, I'm not sure what you mean by standard of care and how that would be incorporated. So I just need to understand that better.
That's in the investment policy. There's one section that says standard of care. That's the headline on it.
Well, yeah. But that's that I go along with the governor's concept is I think I wouldn't use the 1992 definition. I would use the statutory definition. And we should put in, and if we need to modify the statutory definition in the statutes, we'll do it. And obviously this is the number one topic on JAC during this interim, to work with that language. And so as we finalize this language, I think the language needs to mirror our draft legislation so so they work in tandem to do the same thing. On the proxy manager, to me, that's a different issue. Figuring out how you're going to fund it and have language that talks about if you can cooperate with the Wyoming retirement system. It spooks me out of the gate when you say there are some companies that are pro ESG and some that are not. I mean, that just tells me that why would a company, whoever that does that for you, theoretically we do exactly what you tell them to do and nothing else but. And so the idea that you've got different ones that have a different flavor, I'd just like to understand that more.
Yeah.
And understanding the costs, and also the kind of some of the language on what the repercussions are, I'm not sure I fully understand, and how you would implement that. It sounds like a discretionary thing without rules and regulations and a process that would involve the SLIB, or how that would work. So all those things, I think, we can just line all of these up as I'm making notes on it, and we'll just work through them all, I think, in JAC as we start working through this. And we could probably even have a specific work group do this as we play with this between now and July, and then at your conference, so we can really kind of do the deeper dive on it.
Yeah. I think pecuniary, we use that because it's got some history in Florida and how they
Well, actually, it doesn't have history in Florida. It's brand new. They just came up with the
more history than we have.
Yeah.
I'd say.
Yeah.
You know, but on your concerns as far as the furtherance of social, political, and ideological interests, you know, I agree with you from the standpoint that we may indeed invest in some areas of that would be considered green if it's going to make us money.
Yeah.
You know, so you know, it's not that you're going to divest from Tesla because they're an electric car manufacturer. You know, those are things that you're not going to get into. It's all about making the state money. And then when we look at these things, is that, you know, I say the state treasurer's office, which basically means that it's not going to be the state treasurer. It's going to be the office, and a lot of these things that might be brought to my attention will probably be brought to my attention from the investment team if there's something going on out there. So you know, it's not a one-man show, so to speak of.
And Mr. Treasurer, I think really good work and good points that the representative brought up. I think it talks about we can still do some work on it, which I think is good. I do want to be particularly mindful about separation of powers as we do that, but Mr. Secretary.
And Mr. Chairman, I do think that's where there's a little bit of a divergence here. I mean, there's ESG neutral, which is more where this is going, and there's anti-ESG, and I personally think there is a place for us to consider the furtherance of our interests as a state, and that's one way to approach it rather than the pecuniary approach. And anyway, you can go back and forth on that, but I do think there are differences there, and you see that in the legislature with the different bills. I mean, and I align more on that anti-ESG approach, and you can go back and forth on the language, and I think we will over the coming months.
Yeah, Mr. Chairman, to that point, you know, in my statement, I say resulting in less funding being available to the state of Wyoming in general.
Yeah.
And that's broader. I didn't put that in the IPS, you know, and I think those are all good points that people have brought up, and I think we can put a glossary in there if it's, and I think we have that in an appendix of investment terms already. So, you know, yeah.
And thank you, Mr. Treasurer. I think, you know, being mindful of the fact the more precise we get, the more loopholes there are and the more constraints there are. So I think trying to find, you know, that's why I like your statement. But I do think the representative and the secretary have brought good points too. But I think broadly, it is to this board to be able to, we ultimately set the IPS and we ultimately pick the managers. And so Yeah. Thank you. Further questions, comments? Patrick, any?
Yes, Mr. Chairman, just one thing that we did not discuss is the gold portion in the asset allocation. I skipped that inadvertently. And I know Secretary Gray had some comments that he wanted to make on that one.
And is Josh coming up for that again?
Yes, he is.
Great, thanks. Mr. Caven.
Mr. Chairman. Well, similar to Wood and Nichols, we also are not recommending strategic allocation to gold. We had a slide in your deck that showed something, and I think Russell Reed said it earlier. It's a terrible long-term investment. Lower returns and more volatility than both stocks and bonds. It can be interesting during certain types of markets. So it can be more interesting from a tactical perspective, but that is not what your investment policy deals with. Your policy deals with strategic asset allocation. The investment team does have use of an opportunistic bucket that they can use if they decide that gold is where they would like to place their bets. So you do have in current policy an ability to add to it tactically. But it's not something that we see commonly recommended as a part of a strategic asset allocation.
Mr. Treasurer, if memory serves, the retirement system looked at gold a little while back. How has that performed?
Yeah, I can't recall quite. I think they've got 100 million or something like that in there. It's a fairly large, but it's part of their cash.
Too. Mr. Chair, Mr. Treasurer, we could ask Tom if he's on, but I believe he mentioned either Tom or Sam that it was 250 million in our last meeting, but.
Tom, do you want to address that? If you're still there.
Yeah, Tom, I don't have that asset allocation in front of me, so have you got?
Sorry. Yeah, no, I'm sorry, Mr. Chair, I'm here. I can, if you give me a second, I can look it up, Mr. Chair, very quickly. So let me get back to you on that. 150 million.
150 million.
Okay.
It's our goal position.
Out of, and what's the total portfolio? 6 something, 7?
For the pension, 10 billion.
10 billion, okay.
10 billion.
The question from the representative was, how are you holding it?
We have it through an ETF.
Okay.
Yeah, we weren't, originally we had it with futures contracts, but it was too expensive with the roll costs, going every quarter. So we have it through an ETF.
Thanks. And Mr. Chairman, just a clarification, Josh's comments on the opportunistic, that we have an opportunistic bucket, but Grosvenor, our opportunistic manager, I have asked them specifically if we wanted to make a one-off investment in something like gold or oil or what have you, could we do it? And they said no. So we do have an opportunistic bucket, but we do not have the vehicle or a manager who would implement it for us. Now, we could take an ETF weighting within our other like equity portions or whatever, but because of our contract with Grosvenor, we couldn't necessarily, all of our opportunistic investments at this stage need to go through Grosvenor. So that's the one area that we wouldn't be able to just say Grosvenor buy us 100 million in gold per se.
Yeah.
Okay.
If we would have done it, would have been when I first got in office, because we would have made some money then, but no, I don't know. The price of gold, is pretty high right now to think that we're going to get a lot of inflation protection on it. Because inflation is probably going to be going down, so and that's why you buy gold, is for inflation protection. And I think we're going to be on the backside of that pretty soon.
Well, thank you, Mr. Treasurer. Any further comments, questions? Mr. Secretary.
Yeah, Mr. Chairman, I want to ask what they're trying to illustrate on slides 53 and 54, because I'm not 100% sure what the thrust of it is. Is it related to the gold, or is it on it's the two slides. I don't understand what you're trying to illustrate.
Mr. Chairman, Secretary, 53, this was the one that I just wanted to mention, the one that has all of the prices. So every week when you have a meeting, we always want to look at valuations across the sector. And so I just included this for you to kind of just see when you're looking at allocations, how rich or cheap things are on a short-term basis and long-term basis. So if you look at, let's just take the S&P that we mentioned. At the time, it was 4130. We're less than that now. But if you see the one-year range, you can see where that is in that range over the one-year range of where we are. And on the one-year range on that bar, we're on the wider range. And then it just is a change, percent of change, a 1 week, 1 month, 1 year, then the latest. And the big one for your perspective is big term is the 10-year percentile. So obviously one percentile is extremely cheap, 99th is the most expensive. And so that kind of just gives you the perspective. And that's when I mentioned the S&P 500 on a 10-year percentile is the 69.18 percentile, which is on the higher end of the ranges. Bank loans, I think, are 98th percentile or what have you. So it kind of just shows you over a 10-year period where the valuation is. And I just thought during this asset allocation, it would be kind of interesting that you would see what we look at every week to kind of understand both on a short and a long-term basis where the values were. Is that helpful?
Yes.
Great. Any further comments?
If you guys got some suggestions for this, IPS and statement or whatever, if you could get back to us as soon as possible, so we can have a discussion on it and see where they might fall into.
Fantastic. And I particularly want to thank the members of the IFC. It's really good to have you here. I know the treasurer and I have talked a couple of times about ways that we can make your time more valuable, our time more productive. And so just very much appreciate your being here and your perspectives. Mr. Treasurer, outstanding job. Thank you. Thanks, Josh, for what you've done. Any further comments?
I would just really like to thank the ISC for that asset allocation we had over the last year, and because that really kind of moved us up in the standings of our peers. So I appreciate the work that you guys do every day, and Patrick started out, I think, with the importance of asset allocations. That if you can do a lot wrong, but if you get your asset allocations right, it takes care of a lot of missteps. So, not that we're misstepping, we're doing that well too. But thanks again.
And Mr. Treasurer, just while IFC members are on, as a hypothetical, I know we've tried it a couple of times. I think you and I have talked about it. I would love to sort of think about the construct of what it would be like if we hedged some of our commodities like oil, gas, income, just to sort of have a better understanding of that. Yeah. I know that's not part of the IPS. Yeah. I know that's not part of anything we have on the horizon, but it could be a very prudent approach.
We had a little discussion last time. Patrick, you want to go into that?
Yes, Mr. Chairman, Mr. Treasurer. Mr. Chairman, I apologize. You had asked us to discuss that with the IFC, and that was on our agenda, and I failed to put that on. The overall recommendation is that the complexity, cost involved, not having a bucket of money to be able to do it and so forth, not having it there at this time, especially valuations and so forth, it didn't make sense for numerous reasons that you and I have talked about before. But that was the unanimous decision from the IFC that at this time, to have that in place and the complexities and so forth were not warranted with our current operations ability to actually implement and monitor and fund.
And I appreciate that. I guess, if there is a good time to do it, I just want to make sure that we've got the ammunition, we've cleaned our gun, that we have the ability to make sure that it all works. And so just sort of conceptually figuring out what it would take to get that put in place, if that's a possibility.
One other thing that I want to talk with you guys about at some point in time, and Mark Governor, probably you first, is the implementation of the constitutional amendment that was passed.
Right.
Yeah, I think at least WHAM, and I think WCDA wants to try to figure out how they can do it without any further legislation. And I'm not sure, just looking at the constitutional amendment and some of the statutes that it went through, I think that there's going to have to at least be a couple of things added to some statutes to make it.
Yeah, and we might be, I think we looked at doing that before in the IPS, so that might be worth doing again. You probably could trot that back out. I think we had a list of securities that potentially could be dealt with. I mean, anyway, I'm just thinking that's a good idea. Very good idea.
From my perspective, I think we need to have a discussion about what we would like the legislation to look like. And I think there's some modifications in a couple areas there that I could discuss that I think that would be just a couple of changes. One that says it just has short-term investing. I think we add long-term, and then we make it express in another area that it's actually capital stock and stuff. So that it's fairly simple areas to change in statute that would allow us to run to the finish line.
Fantastic. Thanks. Well, I appreciate everything we've done. Thank you all very much. And I will use the chair's prerogatives to say we are adjourned. Thanks.
Thank you.
Thank you.
Thanks, everyone. Thank you.